Go ahead and unmute so we can hear you.
Morning.
Good morning, sir. How's everything?
Oh, everything is awesome.
Listen, tell us, what part of the country are you in?
I'm in Houston, Texas.
Houston, Texas. Listen, folks, I met Jerome not too long ago. And in fact, I've even been to his house. Good morning, Daniel. How are you doing, sir? Listen, why don't everybody do this? Say good morning. Tell us where you're from, where you're listening from, whether you're online or in Clubhouse. Tell us where you're from and say good morning, because Jerome has some very good information for you. Jerome, I've been to your house.
Yes, sir.
It is a lovely house in a fantastic neighborhood, not that far from the airport. Okay. which I did appreciate. But there's something special about your house that probably most of the houses in your neighborhood did not get to take advantage of. Can you tell us what that is?
You put me on the spot, this morning, but it's okay. Total cost out of pocket for my house, believe it or not, was zero.
Wait a minute. Start over. How much out of pocket?
It was zero.
Zero. No dollars.
No dollars. I used my credit card. When I mean zero, I used my credit card for my inspection.
Yep.
And my wife ended up getting all of her earnest money back. It's just creative financing, Don. That's what it is. It's just creative financing. So there's ways of doing this throughout the country. If you know and you deal with the right people that know how to do this.
Okay, wait a second. They say they can't hear you on Clubhouse for some reason. Okay. Hey, wait a second here. There we go. Try it now. Can you say something now, Jerome?
Good morning. I'm Jerome Pemberton from Houston, Texas. Can you hear me out there?
All right. Can we hear everybody? Can you hear them on Clubhouse now? Okay. So, all right. Good. Okay, Jerome, we can hear you on Clubhouse and we can hear you on YouTube. So, okay, folks, you want to go over on YouTube if you want to catch all of this. And Jerome, tell us a little bit about what it is. Can you do this for anybody, anywhere in the country? Help them to get a house with no money down?
Right. Of course. No money down is not a new concept. The answer is yes. You still got to meet the requirements, the bank's requirements, though.
Right.
But what we want people to know today is, yes, you can. You know, there's a lot of programs out there. There's been programs out there for a long period of time, Don. People just may not be aware of them. You know, there's a lot of misconceptions when we use the word programs or down payment assistance. People get real spooky and leery about it, especially on all these platforms. But you can get a conventional loan, right, in most states up to $1 million, which most people are not buying $1 million houses, right?
Right.
But they can buy a house, not have mortgage insurance if you meet the guidelines. That's the key to all of this. If you meet the guidelines.
So let's put it this way, because I don't want to misspeak. If you can qualify for a mortgage where there is a down payment, all right, if you can qualify for that mortgage, can you also qualify for the mortgage with no down payment?
That's the question that people don't believe, Don. When we did this over 25 years ago,
yes,
I came out of financing. I went back into financing. It's just there's banks out there that will give you the money. Now,
right.
The big thing, because you're on the show and we have a lot of family members of your show, right?
Right.
Credit is, the biggest thing, right, for most people, but you brought plenty of people on this show that you can get your credit fixed, right? And so just get your credit fixed. Like, don't debate about that. Like, go use, what's her name? The credit queen. Just go, stop playing around and just go get your credit and don't wait till the last minute. And if it takes you a year, if it takes you 6 months, 4 months and stuff, we are in America, right?
Right.
We operate off of credit. And I just can't believe that people will play around and not go get their credit fixed. That makes no sense to me. Like, no sense.
So let me ask you something. So what if you have spotless credit? What if you have, You've got an 800 score. Everything is going right for you. Can you help that person get a mortgage with no money down?
We can. And then now we got to deal with, do you bring in enough income to qualify for the house that you're looking at? So
Mm-hmm.
what people don't understand is this concept is not a difficult concept.
Mm-hmm.
Like it's like it's an open book test, like when you're in school, right? If you
Right.
meet the guidelines of the bank and you know the guidelines, all you got to do is meet the guidelines, and the bank is going to give you the money.
Okay. All right, folks, let me tell you this. All right, so while we're talking to Jerome, I need you to make some notes because later on in the show, I've got some other stuff for you. 5 things you should never do when getting a mortgage. 5 things we're going to cover today that you should never do when getting a mortgage. And number 1 is the lowest interest rates are not the best interest rates. And I'm going to put this on the screen so you'll be able to see this. The lowest interest rates are not the best interest rates. All right, we're going to talk about down payment deception. Even if you're not working with Jerome and you have money for a down payment, we're going to show you how to use that money for your that used to be for your down payment, how you can use that money more efficiently. Never, ever, 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 never, ever put a large down payment on a mortgage. Just don't do it. Now, interest rates are getting, that's number 2. Number 3, interest rates are getting ready to come down. Okay. But you want to be careful about refinancing. So we're going to talk about refi fantasy today. Don't ever refinance your loan just to get a lower interest rate. You actually make it harder to pay your loan off faster and cheaper. Okay. That's number 3. Number 4, debt consolidation. Some people are actually refinancing and then taking some of that money out of their house, out of their equity, and paying off high interest loans. Oh my goodness. I'm going to show you when you do that, when you take money out of your loan and out of your equity and pay off high interest debt, you're actually setting yourself up to pay triple digit interest on that loan. And I'm going to show it to you. Okay. So don't do that. Don't do that. Student loan larceny. Don't be afraid of student loans, but don't let them steal from you either. We're going to show you how to beat student loans so that they don't take you to the cleaners. All right. So don't let student loans take you to the cleaners. And oh my gosh, we have another one. Never ever buy down the rate. Don't let anybody else buy down the rate for you either. There are people out there who are builders, and as an incentive, they'll say, listen, let us buy down your rate. Let us get you an interest rate. It's not at 7, but at 5.5 or 5 by working with them. I'm going to tell them, don't buy down my rate. Give me that money to do something else with. Help me with my closing costs. And then that money that I would have used for my closing costs, I'm going to show you how that can knock 2 or even 3 years off your mortgage. So there's 5 that we're coming up. We're going to be coming up on 5 or 6 things today, ladies and gentlemen, that you don't want, you never, ever, 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 ever want to do when getting a mortgage. Come on, Ken. What are you doing in the audience, man? I see you out there, Ken. Come on up. There you are. So, folks, come on. And I got Jerome Pemberton here. And Jerome, give us a little background on how you got started in this business, and give us some, and then tell us just a couple of cases where you have helped people get mortgages for no money down. Go ahead, Jerome. You're on.
Well, how I got started in the industry years ago, I was a public school teacher. Of course, couldn't pay my bills, so I had to get into something different. So I ended up becoming a loan officer years ago, and I was intrigued of how many programs that were out there that were never being offered to people. And then that's when I really understood that, one, anybody can get into the industry, go get a license, spend under 30 hours and start selling money, right?
Right.
And you don't need to know anything about how money works. You just need to know guidelines, right? And processes, things like that. So over the 25 years, when I got in the industry, I was like, why should I take my money, right? And put it into this liability. And when the bank is going to give me all the money and I can go buy houses, right?
Right.
As a primary residence. And that's how I got started in the business. And to this day, we've helped thousands of people, right? Buy
Yep.
houses, don't have to put it, they don't have to put a down payment down unless they want to. And we do that to this day. I'm in Houston, Texas. I moved from New Jersey, was where I started. And we started doing this on the real estate side. And we give people more choices and more options. They can do whatever they want to do. If they want to put a down payment down, we don't fight them with that. They have no clue of what they could have done and lowered their years of payments on a mortgage. And they're not willing. Some people are just not willing to come onto the show to get understanding. And I would say, thank you, Don, for really breaking it down to people, because I was ignorant of, the amortization table until I read your book. I had a better understanding, and everybody doesn't want understanding. But that's how I got in the business. That's why we opened up a mortgage company. Also, we had that had over 26 different banks that offer programs where you don't have to put a down payment down.
So you have access to over 26 different banks.
Yes.
That offer no money down mortgages. And this is like a continual process. This is not just a special program.
No, it's a continuous process, Don. And people don't understand that. There's a lot of people in real estate, they want to sell. That's our job, is to sell, right? But when it comes down to your money, or like you said earlier, dealing with the builder's process is to bait you so they can move inventory. That's their job, right? The salesperson that's in there, his job is to sell the house. It has nothing to do with your finances at all. That's what they have to do for marketing, to get people to move product.
So let me ask you this, now, folks. I need you all, if you have any questions, come up to the stage. I see Michelle is on the stage. How are you doing, Michelle?
I'm doing well. How are you?
Excellent. Do you have a question about this for Jerome?
I do. I'm not ready to ask you yet. I'm still listening.
Okay, that's quite all right. You listen.
I'm gonna jump in when I'm ready, though, because I do have questions.
So listen, I need you, when you're ready for your question, I need you to jump right in. Interrupt us, okay? Okay. Okay. Interrupt us with your question. So Jerome, tell us about a couple of people. No, before you even do that, because there are people in here that may have to go to work or something.
Right.
They've heard enough that they want to contact you. How does someone contact you?
I'll do this for you again, Don. I'll give my cell number.
No, how do most people get a hold of you?
They go to the website.
Okay.
So we have two websites. One of them is zerodown.house.
Zero
Zero
down.
DOWN.house. HOUSE.
Okay, so it's zero is spelled out.
Down DOWN .house.
.house. Okay. Zero down .house. Did you hear that, everybody? Zero down .house. Let's go ahead. Somebody put that in the chat for me, and I'll put that in over here on YouTube here. Zero down .house. What else you got?
And they can catch me on my cell phone, 281-220-9960. And we'll do a 15-minute free consultation for your people, and we'll just talk.
Wait a minute. So for everybody who's on this show right now, listening to the show, you're going to do a free consultation?
Free consultation for them.
And you just gave out your phone number. What is that phone number one more time?
281-220-9960.
Okay, 281-320-99.
281-220-9960.
Okay, 9960.
I'll put it in
Okay,
the chat.
281 220-9960. All right, everybody, that's it. That's the number. Write it down. All right, keep it running. So tell us, give us a couple of instances, Jerome, where you've helped people get zero down, get
Okay.
into a house with zero down. I mean, I mean, some of your great stories. I know of at least one because they're my client as well.
Oh,
So
okay. Okay.
tell us some
So,
of those stories.
so one, I don't know if everybody heard before. Um, when I got married, my wife came here and she met me as a loan officer. And I basically told her she didn't know about zero down. And Don, you came to the house and you see my
Yes,
house. So I
yes, I
told my
have.
wife, she came here. Again, we talked about credit. We fixed my wife's credit. And at the same time, while we were fixing her credit, we were looking at different programs. Now I'm talking about my situation, right? So we looked at different programs and we had an option of different programs to use where we didn't have to put a down payment down. Um, and we bought our house, our total cost out of pocket was zero.
Mhm.
And I told you earlier, I don't know if you could hear me, we used our credit card to pay for the inspection on the house,
That's right.
but it was zero out of pocket. So, but it's a formula, right? We
Mhm.
chose the program, we chose the bank, we chose what needed to be negotiated for us. We didn't do no buy down or anything like that.
Mhm.
We moved into the house. It was structured that way from day one versus what most people. So that was one. Donna had my son, right? He was living with us and he didn't want to pay us rent anymore, right? You
Right.
know, so he comes to his mom, comes to Danette. You met my wife, Danette,
Yes.
and he was going to go in an apartment and he had pets. This is a
Mhm.
real story, guys. And so he had to pay a pet deposit. And he was like, why are you going to an apartment when you know your dad helps people get into houses? He was 23 years old because he broke my record, right? That was something else the kids wanted to do. I want to get in a house before because you bought your first house at 24. So he bought it at 23. His
Mhm.
total cost out of pocket was $100.
Got
And I'll
it.
give you a tip. The plan for the family was, hey, stay in the house, right? Because now I'm talking about you could talk to your accountant, right? He stayed in the house 3 years. He sold the house, made $77,000 using the bank's money. He borrowed the bank's money, stayed in the house, didn't have to pay capital gains tax. And he sold his first house 3 years from now and made $77,000 in him and his wife's pocket and moved to Michigan and bought another house. How about that strategy?
Are you kidding me? No money down, and for a young person,
Young person.
and then stayed in the house and then sold it at a profit, but moved in with no money down.
Mm-hmm.
Oh my
Yep.
gosh!
You can do it for the rest of your life if you understand it. If you understand what we're talking about, of leveraging the bank's money, right? We're
Yep.
not even talking about even adding your method, Don, because it would have been crazier
Yes.
if you would have
Okay.
added your method. And so what I'm telling everybody with confidence, if you understand how the banks work and you know how to get ready utilizing the bank's guidelines, you can choose the program and get ready for the bank and fly through the system if you have understanding.
Wow, wow, wow. Ladies and gentlemen, I need you to know that by using this system and the pill method, once you get that mortgage, pay it off in 7 years. I mean, you're getting equity at 5 to 7 times the regular rate. You're getting equity cheaper. You're paying off that loan cheaper. All right. And then as you get that equity cheaper, then you can leverage that equity into another house, into investment property. There's so many things you can do, but it can all start. It can all start with no money down. Tell us another story.
I can go on
Listen,
and on and on. I can go on and on and on because we do this every day. Like
come
this is
on.
something we do every day.
Well, see,
So
the reason why I want you to tell a story, or the reason why want to tell a story is because I've been doing what I've been doing for a very long time, and it took some time for people to catch on. And right now, everybody thinks that you have to have money down, whether it's 3% or 10% or 20%, but they they need to be able to hear it over and over again because they're dealing with something going against things that they've heard their entire life. But they need to hear from you and people that you've helped actually buy a house with no money down. Tell us another story.
Let's talk about Miss Willis. Miss
Okay.
Willis came to us about a year ago.
All right.
And it wasn't that she couldn't buy a year ago. She heard about this concept. She made enough income because we did her debt, we figured out her debt. We knew her credit scores. Only thing that was stopping her for the specific program where she didn't have to put a down payment down and she could finance the closing costs.
Right.
So we got Diane ready. Diane already was looking at houses, because here's what we tell people to do everything all at once. Continue to look at houses online, continue to look at houses, do some due diligence on where you want to live. So Diane, we went to the builder. Diane knew the area. We looked at some houses. She knew exactly where she wanted to live. She also knew the product because we had to get her credit fixed to get her credit score up to meet the guidelines for a specific bank. Mm-hmm. She knew exactly the program before she even went on the contract, and even before she was looking, how she was able to buy a house, a single mom with 3 kids, right?
Right.
She knew the plan. And because she had that plan, she was able to buy a house, brand new house that was in the process. They call it inventory home that was being built. Mm-hmm. Total cost out of pocket was $1,500. $1,500. This is Diane. $1,500.
And this is a new build.
New build house. She picked the house out. She picked the location, everything in the cul-de-sac. And just to see her, the transition from working the plan, and it didn't hit her. Didn't hit her at closing. I was like, Diane, when is it going to hit you that you're a homeowner? And when it hit her, it didn't even hit her at closing. It hit Diane. It hit Diane when she received the keys and she had a granddaughter with her, and then she put the key in the house.
Wow.
That's when she realized that she was a homeowner. And it feels, and I tell people this all the time, mm-hmm. when you structure a deal like this, it doesn't feel real because psychologically it sounds crazy that the bank will give you the money to buy a house versus all their family members, or what people hear and they talk about, that this is not real. I deal with this every day, so I get it. I have to tell you more stories. I get over 4,000 calls a year where people think I'm a scam, and I tell them this. I said, how can I be a scam if I don't ask you for any money? How can I scam you, right? They was like, it just don't sound right. And it's the same thing when I'm at the country club, right? And I'm talking to someone, right?
Right.
And it was like, can you, I said, look, you spend all this money for your Russ. Russ is another story.
Okay, come on, tell us about Russ.
Russ and Bree. So Russ' dad, I mean, Brianna's dad is Brianna's dad.
Yeah.
Brianna's dad was my wife's supervisor.
Okay.
And so they're talking one day, and he lives in very expensive houses in Houston, right?
Right.
So I don't think he was a believer until I helped his daughter, because he paid for his daughter's wedding. So I'm like, why would you spend all this money on your daughter's wedding, and then you got to spend money for her to give them a down payment for a house? Let me
mm-hmm.
handle that part, right?
Yeah.
And so when they bought their house, again, right, with a plan, with a process, getting them fully qualified, their total cost out of pocket was probably under $3,000. And here's the crazy part about it.
Okay.
They rented 2 rooms in their house that paid the mortgage.
Oh my gosh. So they're house hacking on top of it.
They taught me that when I said, what? They said, I already got 2 roommates in the house. We're going to get married. We're going to ask the roommates to move into our house, but we're going to move into this house with very little money out of pocket. And the 2 rooms that they get from the roommates paid for the mortgage.
Oh my goodness. I don't see, listen, if you're watching us on YouTube, if you're watching us on Facebook or LinkedIn, I need you to put some questions in the comments, in the comment section. If you're here in Clubhouse, all right, listening to us, I need you to come to the stage and ask this man questions while you got him here, because right now it's free. All right. But listen, they got your number, they got your website. And since they're not asking questions, let me ask this question. Is there a downside to no money down? Is there a downside to it?
Okay, so this is controversial, and let's just put on the table. We got a new president in and everything like this. Everybody's going to make their new declarations for this new year and all this other stuff like that.
Right.
Here's the problem with what we're talking about today. The problem is they haven't been on Don's show, right? That they haven't listened in of what you're telling people to do is totally contradictory to what the real estate industry is saying for them to do.
That's true.
So that's the problem. So the problem is the builders and people, when people come, they come in, the first thing they're going to talk about, Don, is the rate.
Right.
That's the number one thing right there. If you could overcome and understand a plan for your family and go in there with your own plan and saying, okay, I'm going to buy this house.
Right.
I'm going to use the P.I.L.L. method. I'm going to do what Don tells me to do because my house is going to be paid off in 7 years. Let's just use that for example.
Okay. Right.
So when you go to the builder, because I deal with this every day when people call me, and the builder's offering a rate, let's just use the example today for 3.99. And they used all this money to buy this rate down, right? To bait you in to go buy this house, right? Which is in the price of the house, right?
Yeah.
So that just lowers the payment because everybody just say, well, doesn't it lower the payment? And the answer to that we all know is yes.
Yes, it does.
Yes. But that has nothing to do with how much interest you're going to pay the bank. And that's where people have a problem with, and they don't understand that portion of it.
So what he's talking about, folks, is that people will focus on the rate,
right?
But they have no idea what the cost long term is going to be. And I'm going to show you how you can lower the cost on that loan, even at the higher interest rate. And I'm going to show you the numbers. Okay. So people find it hard to believe that. So are you trying to use my situation to tell me that it's hard for people to believe you too?
Every day. Because they're going to look. So what we're going to do is take the rate that the builder or somebody's offering, right?
Right.
And that's the principal and interest, right? That has nothing to do. I want people to understand this.
Mm-hmm.
Your payment, you need to understand what makes up your payment.
Right.
Right. So there's insurance. No matter who you use, the insurance on that house is going to be the same.
Mm-hmm.
The taxes on that house, right, is going to be the same. The only thing it changes is the principal and interest, and if you have mortgage insurance or not. That's what you got to deal with, is those two boxes right there. And then the third box I tell people, Don, to deal with, what is your total cost out of pocket? People forget about that. So people call us in always asking for money, right? And I said, do you have the money for the down payment? No, I don't have it. So why are we having this conversation? Why are you worried about what the interest rate is going to be on the money that you borrow for someone else? You just told me you don't have this $30,000, $40,000. I'm telling you there's a program where the bank is going to give it to you. You don't get a chance to tell the bank what rate they're going to give you if they borrow the money. That's like somebody comes and borrow the money from you, Don. I go to you, Don, right? And I say, I need $400,000, Don, and I want you to give me that 3.5%. And you're gonna look at me like I'm crazy.
Yes. So what you're
telling me what your rate is going to be for me to borrow money from Don.
So what you're saying is they don't need the $30,000 or $40,000 to move in. All right, that's been established. But now they're not going to buy because the rate isn't low enough.
Exactly.
Oh my gosh.
Exactly.
Oh my gosh.
And Don, they don't understand this from a real estate standpoint. I'm very good at watching patterns all of these years, right?
Right.
There's a lot of stuff we tell people it may happen, but it may not happen. And nobody can guarantee you this, right?
Okay.
And one of the things I tell people, okay, go ahead and put 20% down, but here's what I can't guarantee you. I cannot promise you that this house will go up in value.
Mm-hmm.
Nobody can promise you that.
Mm-hmm.
We hope and pray it goes up in value.
Right.
But you may lose that $20,000. People don't think about that. So when you're dealing with a builder and they try to get out of here and they drop in prices and stuff like that, there's clients out there that got to bring money to the table to get out of that transaction.
Mm-hmm.
Nobody wants to talk about that.
Well, let's talk about this. Then I'm going to put this on the screen, and we're going to walk through this with me. If you have a separate screen over there, Jerome, you can pull it up on YouTube and see this, because I've got a $400,000 house here at I got at 7%. Okay, and I'm going to tell you folks that if I can afford the payment, I want this 7% loan. I don't want anybody buying it down for me to get it down to 5. So let's just set this up for them, Jerome. We got 400,000. It's at 7%. You've already helped them, right? They had the money to put down, but they decided that you help them so that they don't need to put it down. The builder is offering an additional incentive to pay somewhere between $12,000 and $17,000 to buy the rate down. Okay. And you're going to tell, and so I'm going to walk in and I'm going to tell them, yeah, I want the house, but I also want the 7% interest rate. Don't buy the rate down. Help me with my closing costs. Give me that money for closing costs. Okay. All right. So here's the scenario, ladies and gentlemen. We've got this house here, 400,000 at 7%. The payment is $2,661.21. Okay. The total interest that the bank wants on this is $558,000, which they're not going to get. Okay. Mm-hmm. And let me see. And the total interest paid as a percentage of principal, that 7% really means 139.5%. I don't want that to scare you. I want that to encourage you, because you don't have to do it that way. You don't have to do it the bank's way. So here's what I'm trying to say. I need you to take a look at cumulative principal and cumulative interest. I'm going to tell the builder, don't buy my rate down. Let me have that 7% because I can afford the payment. Then the $12,000 to $17,000 I was going to use for closing costs, I'm going to let the builder pay that for me instead. Don't buy the rate down. Use that money for my closing costs. Help me with that. Okay. So I still have some cash. Is that right, Jerome?
Exactly. And that's
right. So if I have my if I have my $12,000, I want you to see this, everybody. If you're not seeing this, if you're on Clubhouse and you want to see what we're doing here, there's a link at the top where it'll take you straight to YouTube. Okay. So let me put this on the screen for you so that you guys can see this situation. So I got to change this over so you guys can see it. Hold on. All right. Let's change this over so that you guys can see this. All right. There we are. All right. So here is the loan. Here's the loan. All right. 400,000 at 7%. The payment is $2,661.21. The builder says, I want to buy this down for you. I want to buy it down for you to turn it into this, where you can get 5% and a payment of $2147.29. And then your very first payment here starts on payment number 1, where $480 of your dollars goes to principal and over $1,600 goes to interest. All right. That's what you have. That's what you're dealing with. So I'm saying, no, take the 7% loan, let Jerome help you get in with no money down, so you don't have to use that money. And then the money you would have used for closing costs, you get to keep, because now the builder is going to help you to pay your closing costs for you. So I have like $12,000 to $17,000 that I could use because I didn't have to pay it. I didn't have to come out of pocket with that. Let me show you what can happen. Let me show you what can happen at 7%, a payment you can afford. Okay, 7%. Watch this. Watch this. See cumulative principal here? This is how much principal you would pay down when we add up all the principal payments. So I'm going to take my $12,000 with my first payment and put it with my payment so it could go straight to principal. Watch what happens. I'm scrolling down here. That's $4,000. It knocks off 1 year. Here's $8,000. That's 2 years. 12,000. $12,000 knocks almost 3 years off this mortgage. Okay. The money that the builder was going to use, all right, the money that the builder was going to use to buy my rate down. Okay. I've said, listen, don't buy my rate down. I want to keep that rate. We're going to now use your money for my closing costs. I'm going to take that money that I was going to use for closing costs. I'm going to put it on my mortgage. $12,000. Look here. And it saves me $78,000 in interest. $78,000 in interest, and knocks almost 3 years off. What if it's 17,000 they were going to put down and I have $17,000 to use? Look what $17,000 does. It brings me all the way down here, top, knocks off 46 payments and saves $105,000 in interest. And that's where I deal with it. Catherine Giles on YouTube is asking a question. Here's the question. Is there going to be a PMI with the no money down method, Jerome?
It just depends on what you qualify on. Depends on the product. But what I tell people is, I don't know why people keep saying PMI is a bad thing. I want you to understand why I'm saying that. Because if there weren't FHA loans, right, then a lot of us, especially in people that look like me in the community, wouldn't be able to purchase a home. So if there was no PMI, I just want people to understand that. So people need to stop saying that PMI is just insurance. It's not a bad thing, but you're being told it is. So, but can you qualify for a home where there's no PMI? The answer is yes. So every program has debt to income restrictions. Every program has a minimum FICO score requirement. It just all depends on the person. Again, it's customized to the family. And so sometimes if you still want to buy a house, right, where there's no PMI, you may have to increase your income because there's going to be a cap on the loan amount you qualify for. So if you want a loan with no PMI, the answer is yes, right? You can get a loan, right? But it might not be enough based on what you're going to, the amount that you're trying to purchase. So this is custom. So it all depends, right, on your situation, where you're trying to buy, and how much you can qualify for.
Well, let's talk about this. Let's keep that thought going about PMI, and let's just say that you have a conventional loan and not an FHA. Okay, you got a conventional loan and you start out with PMI. Once you pay that loan down, get what is it down to 80% loan to value?
Correct.
Okay. Once you get it down to 80% loan to value, what can you do?
They would drop. You can ask the bank to drop the PMI.
You can ask the bank to drop the PMI. If you're working with the P.I.L.L. method and you can pay off the entire mortgage in about 7 years, how fast can you get to 80% loan to value?
You will have zero.
Okay, so you can get the 80% loan to value maybe in a year and a half.
Right.
Okay, maybe 2 years at the outside, and then you can drop the PMI. So don't let that get in your way of becoming a homeowner. So let's see, Cataline, does that make sense? So if you want to know more about this, contact Jerome at 281-220-9960, 281-220-9960, or at his website, zerodown.house. If you want to know more about the P.I.L.L. method, here's what you do. You go to ICE. Let me see. You want to go to ice10k.com. ICE, okay? ICE, ICE, the number 10, the letter K.com. There we go. ice10k.com and request a savings and earnings report. This is what it will look like when you go there. ice10k.com. What you'll see is the hip hop preacher here, okay, Eric Thomas, ET. Scroll down underneath his picture and click the button that says Get Your Savings and Earnings Report. There it is. It's free. Get your free savings report now. Fill out the information, and then it will let you into step 2. And then you can know the month, day, and year you could be debt free within a 7 to 9 year window. And then we can predict when your PMI will drop off. Okay. So there's 2 things to do. Contact the P.I.L.L. method at ice10k.com. That is my digital business card. And let's work together. Working with Jerome, working with the P.I.L.L. method, we can not only get you no money down, but pay off all of your debt in an average of 7 to 9 years. Grow your equity that fast so that you can leverage that equity into something else. What do you say, Jerome?
That is, you know what I'm happy about today? I think a lot of people are going to get understanding today. And I don't want people to not ask questions. And these are great questions that people are asking, because people ask these type of questions every day. And let's go back to your illustration, because sometimes people will see your illustration and realize that they don't really get in their head that you just saved somebody over $100,000 by just using the P.I.L.L. method off of what they were going to pay anyway, right?
Mm-hmm.
To the bank. You just knocked out $100,000 from month within that first year.
Right.
From that first year.
Oh, wow. Let's take a quick break here, ladies and gentlemen. I need you to, if you're on YouTube, thumbs up this video, this podcast. Give us a thumbs up. Also, I need you also to subscribe and click that notification bell so that whenever we're live, you're here. We're going to be giving out great information on this show, and I'm glad to have Jerome Pemberton here. And as we get ready for our Pillars of Prosperity Conference, I'm going to be live in Orlando in January. Live in Orlando in January. And you can get more information if you text the word PILL, P-I-L-L. It's crawling across the screen. Text the word PILL to 256-215-9496. One more time. Text the word PILL to 256-215-9496 for conference information. And right now you can get early bird tickets. Okay. I'm going to be there live all day, and it includes lunch. The early bird ticket is only $175 for all day P.I.L.L. method. Learning how to borrow money at a discount, 75% off. Take that money and turn it into wealth. We're going to add that component. All right. Turn that money that you used to pay the bank, turn it into another $1 million for yourself. We're going to be talking about that. And it includes lunch. You do not want to miss this opportunity coming up in Orlando, January 31. The last Friday in January, January 31, we're going to be live in Orlando. There is the information there. So, Jerome, back to you, sir. So
yes, sir.
You're helping people, all right? You're helping people. Can you give us another example of someone who found it hard to believe, but you ended up helping? Oh, wait a second. I got another comment here. Okay, let's see. Catalina, I hope I'm pronouncing your name correctly. She says, yes, it does. Thank you. I own already and planning on purchasing more and helping my family purchase homes as well. So Catalina, if you're doing that, okay, on top of not putting money down, let's stop giving the bank all of that interest money as well. Cut that interest cost on these homes by 75%. Get your savings and earnings report that's free right now. All right. Find out how much interest we're paying and how much interest we don't have to pay. All right. So Jerome, somebody out there didn't believe you, right? And then somehow you got them to say, listen, give this thing a try. What is it that you have to do? What are some of the things you had to do to get some people to say, listen, just try it. All right. And if it doesn't work, it doesn't work, but just try it. What do you do to get the most skeptical to try your program?
I try to show them a bunch of case studies,
Yep.
which I have file cabinets, and I let them look at them and say, this is what we've been doing. And the other thing is I tell them that these are bank guidelines. And sometimes I have to get them on the phone while I'm on the phone with them, with the loan officer, and to get them to realize like the bank is offering this money to you if you meet the guidelines. And so a lot of the times, Don, what I find out, once we put somebody in a plan, this is what I tell them. Do not take advice from anyone that is outside of this consultation that we're having. If you want them to know about it, they need to be in that meeting.
Wait a minute. That's key. Say that one more time for the people in the back. And wait a second. Let me take this example off the screen so we can get you. I got to change my banner here. Hold on for a second. There we go. All right. So say it one more time. What don't you do?
This is key. When we're talking about these methods, using Don's method or using our method, right?
Yep.
When we have our consultation, whoever's at the consultation, that plan that we put in place for your finances, for your family, right? Do not take any advice from any outsiders because they don't understand. They don't know your plan. They don't know how much income you bring in. They don't know how much debt you have. This is a plan. It's not just you getting into the house.
Mm-hmm.
It's paying off your house off. And it's also what you don't understand. It's also to increase your wealth for your family.
Let's talk about that for a minute. So what you're saying is there's not a whole lot of businesses out there that do what you do, correct? No. Okay. So you've got something that's unique. You have a niche that you've carved out for yourself. So what you're saying is, here's something that I do that disrupts the status quo. We're disrupting home buying. All right. This is something that you do that a lot of people don't know about. Why? So don't go ask somebody else who doesn't know about what you created. Why would you ask advice of somebody who doesn't know the information that you have put together? Okay.
Exactly.
So all they can tell you is no, don't do it. Or the best thing they could tell you is, I don't know if it's true or not. That's the best thing they could tell you. They certainly can't tell you, yeah, go with that guy. That's what you're not going to hear because they didn't create the system. No. The system creator is here. So now what do you do? What do you show them to prove what you're saying is true? Jerome?
Well, the easiest thing, in which you've helped several of my clients after they bought their house and they were talking about paying the house off, I sent them to you to get the consultation. And one of them, I paid for the consultation so they can at least get the appropriate and correct information based off for their family to create wealth for their family, right?
Right.
And so it's no different than if you do some research on a family office and what that really is when they get a bunch of people together to have wealth, right? To go generations, right? You have everybody in the room. So that's what I'm telling people. I'm like, half the people that go get advice from other people, those people are not credible. They don't do this many transactions that we do on a daily basis, nor understand the numbers that we're talking about, right? But I can tell you this. Countless of clients, right, that come in with a plan. I'm talking to you and your family about getting a check, literally getting a check. We're not talking about the first house, right? We're
Right.
talking about you. I'm giving you more options, right? So you can understand what equity is, right? Equity is only equity when you understand what equity is when you either pull money out of the house or when you sell that house, and if you have the opportunity to make money on your sale of your house, right?
Right.
Other than that, let's talk about protection. Your homestead. Every state has some type of protection when you own a home. I think everybody needs to understand that, right? And in
Mhm.
whatever state you're in, you need to get an understanding why you need to purchase a house, which will give you time if something happens in your family, right? Let's say you lose your job. Let's say a loved one moves on, right? I could tell you the countless people that come back to us when they're in a crisis to get an understanding what options available for their family when they purchase a house versus you're in a rental, right?
Wow.
And so that's
Wow.
dear to my heart, right? Because I've had friends that I kept telling them to buy a house, and then during COVID, my best friend dies, right? And his wife is in the house. And I said, man, if my friend would have just listened, right? And I'm dealing with the kids right now. If he would have just listened, his wife would still be in the house because we would have had time to figure some things out because the bank does not want the house. They don't
Mm.
want the house. They will give you more time. We could work with the bank. We could increase the family's income, right? So this mission that I'm on is it's not just me getting a check. It's about raising people's wealth consciousness of decisions that you're making and bringing the right people into a room that know what they're doing and what they're talking about. How you can leverage the bank's money and consistently, if you take one strategy consistently while you're on this earth, right? You could probably bring in $250,000 just by buying and selling your own house and
So,
doing that and
Jerome,
playing that plan.
here's what I just heard. Here's what I just heard. Here's what I just heard. Okay, Kenneth Brown. Kenneth Brown talking. He said, preach, brother. Okay, he's watching us on YouTube. So listen, what I just heard was this: a family comes to you. They're in an apartment. They don't necessarily believe you while they have their finances together, and one of the income earners dies.
Die.
And now they want to come to you with half the income. Now they come to you and say, what was that you were saying to me? Because they're getting ready to lose their apartment because of non-payment of rent.
If my friend would have bought the house,
Yes.
his wife would have still been in that house.
Mm.
Because here's what the banks don't want you to know. You might have heard of modifications, you might have heard of organizations like NACA. What I always tell people when somebody has a house, right? The bank just doesn't come and take your house right away. They just don't. That's not their process, right? They basically want you to say, okay, you haven't been making this payment. Can you get financially stable again so we can make some type of payment arrangement so you can stay in that house? Because that's not how the bank lends money. They have to have a low foreclosure rate to extend and borrow more money if people understand the game.
So let me jump in here. So there's things like deferment.
Correct.
There's things like forbearance. You can get forbearance,
Exactly. Yep.
you can get deferment, but you can't get that on rent. All you get is an eviction notice. If they had gotten into the house, this is what I'm hearing. If they had gotten into the house, they could have had time to fix their financial situation by going through using tools like deferment, using tools like forbearance, because the bank really does not want your house.
No. Don, here's the other strategies you have with all these apps and stuff out here. Let's talk about strategies. You get
Let's
the
talk
house.
about it. Let's talk about it.
Don, they could go. I know people right now. I know people right now that husband and wife stays in the house and they rent the other 3 and 4 bedrooms out throughout this country. They do this. And the 3 or 4 bedrooms that they collect and rent subsidize what they're paying the mortgage company. This is not new concepts. People don't just the number one reason why people don't buy a house, Don, or use your method, Don, is because they don't make a decision and they don't understand a decision.
Mm.
Make a decision if you want to be a homeowner, right?
Mhm.
Especially that people that look like me. It
Right.
breaks my heart, right? Because I see the statistics. I sit in rooms, right? And the issues is every year there's more programs being added, not being taken away. I had
Mhm.
a client call me the other day and said, Jerome, I need to go buy a house right now because this new man is in president. I heard they're going to take these programs away. I laughed at her.
Mm.
I said, one, where did you get that information from? I
Oh
said,
my
do I
God.
seem worried? She said, no. I said, because I have the programs in my house on the screen of all the different banks that offer these programs. And none of the next day in office, they took them all away.
Let, let,
Stop
let,
listening to that foolishness.
let me help you. Do not get your financial information from the barber shop or from the beauty shop. Please don't. Keep going, Jerome.
The number one thing that I tell people, and so I just don't give people and run my mouth is what I call it, and
Yeah.
not give you solutions to your situation.
Mm.
Don, right now, I don't talk about this a lot. I have
Mhm.
2 clients right now, and I could probably take on 10 families right now.
Right.
They're on Section 8. I want everybody to hear this. They're
Come
on
on. I want to
Section
hear.
8.
So you
Section
got
8.
somebody on Section 8. Go ahead.
Section 8. Section 8.
Mm-hmm.
They're going to buy a brand new house while you still worried about PMI. You still worried about what type of loan. You still worried about all these different things. And they're going to buy their house, move in their house, total cost out of pocket, probably less than $2,000. And the government is going to give them money to make that mortgage payment if they're not disabled for 15 years. If they're disabled, they will pay that mortgage, a portion of that mortgage, up to 30 years. And people are still debating to me if this is real.
And you've got your finger on all of these programs. I'm going to put something on the screen right now, Jerome. So here's a term. Let me go change this banner right quick. All right. So we need to change this to this so everybody could see. All right. There we go. All right. The term is cognitive dissonance. Cognitive dissonance. It is a psychological state of discomfort that occurs when a person holds conflicting beliefs. They already believed one thing, and you're giving them credible information that sounds good, so they kind of believe you too.
Mm-hmm.
Okay, so a person holds conflicting beliefs or values, or when their actions don't align with their beliefs. So, in other words, you want them to say, listen, believe your eyes. Uh, when you're talking finances, finances is a math problem.
Mm-hmm.
You're approaching this situation with your feeling.
Exactly.
Stop approaching financial situations with your feelings and look and try to understand the numbers.
Exactly.
Come on, man. Talk to us some more.
So one of the things that when I first put this program together, what people don't realize when I started as a teacher, and when I had to realize that why families don't succeed in the United States, I had to understand the psychology of what they're being told, where people getting their information from, and like what you were saying, get to the point where you have to make a decision. This is what I'm going to do for my family. And these decisions I'm making this decision because I know what I need to do, why I need to do it from a number standpoint. So right now I'm helping kids with the 4-H program when they're in high school and middle school, right? To
Yes.
start making decisions and telling them what decisions they need to make so they can make a certain income.
Mm-hmm.
I don't know if we should talk about that today, because it makes it easier. So it doesn't matter when you get the information, because you could be 60 years old when you get this information. You could be 40, you could be 20. It's when you get information, the question is what's difficult is to say, I'm willing and I'm going to do the work. It doesn't matter what the conditions I'm under right now. So let's break this down a little bit.
Okay.
So one of the things I was telling Don yesterday, my wife came to me, right? There was a lot of things I didn't know about finances because my wife worked at Smith Barney in New York, and she started teaching me things. She said, there's a realm of understanding that you've never heard of because you just wasn't in the room. You just wasn't in the room to get understanding, right?
Right.
And so what a lot of people are ignorant about, I think today, is that how to live the type of life that you want to live, right? What decisions do you need to make to have a certain amount of income coming into your house so you can live that type of life? You got to have understanding, right?
Right.
So when I'm bringing the youth and I'm bringing them to the house and stuff, we're not talking about our feelings. We're talking about we're going to make you do these things because your body, your flesh, your mind doesn't want to do it. Does that make sense? Doesn't want to do it.
Listen,
So
I've been there. I've been there. Go ahead.
Right. So when we build that community, remember community, you might have grew up in a community. If you want to get a certain way, you have to, that's the whole thing about doing workouts. That's the whole thing about doing coaching. You got mentoring, right? But a coach is a person who's going to make you do something every day that you don't want to do. When you're in the military, they're going to make you do stuff. You're going to get programmed. What Don is talking about is reprogramming. He's going to be the drill sergeant. Just do what he tells you to do. And if he doesn't, he should kick you behind. So I'm going to tell you this. I'm going to tell you what broke poverty in our family. I had family members in the projects. I want everybody to understand this.
Okay, I'm listening.
In a previous marriage, when I left college and I came back home, I said, I'm going to be a homeowner. So I want everybody to understand this. We saved the money for the wedding and we got some money back, right? But I made a decision. I'm not going to live in an apartment. And I stayed with her family, right? They thought I was off the wall crazy, just for stand in my stance that, hey, I'm either going to live with my parents or we're going to live with your parents. We're not going to rent a house. It was just a decision.
Yes.
When we bought the house, you got to remember when her parents bought that house, they bought it years ago. So their mentality is buying a house is difficult. You got to remember that when they bought houses back then, when my parents bought houses back in the 70s, right? It was difficult for them to buy a house. So that's their mentality. You got to save all this money. So you got to remember, this is a new generation, right? We got AI, we got technology. We're on the screen right now. You can't think that way no more. Martin Luther King has passed, right? And he says he's given everybody, people coming from other countries here, are buying houses before you are. They're coming to me. They're coming to me. They're coming to me before they get the tax identification number. They're coming to me and say, how does America work? How does finances work? And they're buying houses before people that's been here like me. They're buying houses before you are. And you're asking, and what I'm saying is they're going to get their social security number and they're buying houses. They don't even question about buying a house. The decision was they came to the United States to open up business and buying houses. Let's go back to my family. My family was in the projects.
Yes.
The projects. They made good income, but they had a poverty mindset, a project mindset. When we bought our house, my family came back to me and said, how can I buy a house? And the three of them, three grown people, right, that I love, end up buying houses because we sat down at the kitchen table and had a conversation. This is what you need to do. And they did it. And they was homeowners because it was a conversation. That's what got my family out of the projects. Just by having a conversation just like we're having right now.
Overcoming these generational curses.
Generational. Lack of understanding. We go to cookouts, right?
Yes.
We have fun.
Yep.
Our cookouts are different. When we come to our cookout, we talk about money. So for now, we have kids, younger kids, they're in their 20s. I just had two of them at the house the other day. You know what we're talking about?
What are we talking about?
I'm showing them $700,000 houses right now. You know why?
Why?
Because when they graduate, we already know how much they're going to make. One is going to be a doctor.
Mm-hmm.
Make around $800,000 a year. I said, I'm going to make sure you finish. And we did the math. We said, okay, if you make the minimum of $800,000 because you're going to be the surgeon and you want to work for 15 years. This is the conversation at the table eating. I want everybody to understand this. Yeah. I ain't worried about him buying a house. We're going to fix, if his credit is messed up, it's going to get fixed. But let's see how much income you're going to bring into your family household. All this other stuff ain't going to work because when we sit, all this other stuff doesn't even matter. You know why? Because there's going to be a program for him out there where he ain't got to put a down payment down. He ain't got to pay no mortgage insurance, right? And we're going to negotiate, right? So he can move into this house at an $800 salary. You hear what I'm saying? That's what he's going to get. That's what they're going to offer him when he finished school 4 years from now. Wow. His brother is going to be a dentist. Let's say he makes $250,000, $250,000, right? He's already looking at houses because I want him to see what the end is going to look like, what type of life he's going to be live, because he made a decision to make this amount of income. And this is the type of house you can buy, this type of car you're going to drive. Wow. Let's talk about the average person out here with the average household income. I got something for you. Don, one day we should do a show and just talk about the top 20 things you can do at 50, 60, 40, 30 years old. Because we have people that do that. Go get a certification and go make 6 figures from your house. Did you hear what I just said? I have people right now.
One more time.
I said, right now in America, right, you can go get a certificate or you can make a decision and say, I'm going to go get this degree. You should know, if I'm going to spend this time, how much money I'm going to make in that area when I decide to get this piece of paper, because it's just a piece of paper. Employ that piece of paper to make money for your family. Then guess what's going to happen? The only thing when you come to us to buy a house, while you're working on that, you're going to understand credit. You got plenty of time to get your credit fixed, to look for a certain way. You're going to understand debt to income ratio. It's just a mathematical equation, right? And you're going to understand what the guidelines, even if you got student loans, you're going to know what bank you need to go to where they're not going to count all these student loan payments against you. You just need to understand what the rules are. Once you understand the guidelines, then all you got to do is meet the guidelines on paper. When the bank gets it, you're going to get approved. That's what people, that's what frustrates me every day. I'm like, stop trying to take the shortcut and just fix what you need to fix so you can fly through the system. And that's why people come to us. I give them the guidelines to say, this is what you need to look on paper. But what people are going to do after they meet with Don, what they meet with me, they're going to still keep researching, right? And I laugh. I'm going to tell you why I laugh.
Why you laugh?
There's a lady right now. She's just about to close. And she's a church member now.
Okay.
She puts her information in because I don't tell people this stuff. And she puts her information. She's still looking for down payment money and stuff like that. She doesn't even know it's me. She puts it in, and my wife comes to me. She said, "Look who put this information." She laughs. I said, "See, they still don't believe that that's me." You're in the state of Texas, and she put her information in, and it came to me. And she said, "Well, I was doing my research." I said, "Baby," I said, "you can come to the house, and I'll show you all the different programs, the guidelines, and everything like that." I said, "I don't know what you're looking for. You found me."
So what you're saying is you're trying to tell somebody at church how to do it. They're still looking outside of you, went to your website, put in the information, and was actually your website.
I said, I'll give you the programs. I could tell you which, and some programs, believe it or not, Don, is not online. I tell people that. People don't understand that we are a marketing tech company. I don't tell people this.
Yes.
I was like, we put so much content out there. I said, it was probably something we put out there.
Listen, folks, listen, here's what I'm hearing now. If there is a way to do something, why do we try to find out what's free? If you know how to do it, okay? What is the aversion to paying you to do what you do? I don't want to pay you. Now that I know it's out there, I'm going to go now try to find all this information myself and do it myself and end up paying more money trying to do it myself than if I had just paid you your fee, which is a small fraction of what I'm going to end up paying because I tried to do it on my own.
Exactly.
Okay. So, folks, the fear of loss, I need you to hear me now. The fear of loss is greater than the desire for gain. Jerome is going to tell you, I'm going to tell you what you can gain from the system, and the fee is small compared to the gain. But people are afraid of the fee because the gain is somewhere in the future. So they're going to say, I don't want to pay the small fee. I'm going to go to YouTube University, try to learn it myself, and end up paying a much bigger fee because they're going to be wasting thousands upon thousands of dollars trying to do it for free. Man, oh man, how many people have spent a lot of money trying to do this and then they come back to you, Jerome?
Don, there's people out there that will lie and say they bought a house, and I go look and they rented a house, and they actually had a party to cover and told these people that they bought a house and they're renting a house. I've had people. Here's a recent story last month. Now listen to this, Don. This is a good one.
Okay.
Young guy makes good money, and he comes to us through our website, downpaymenttx.org. I don't tell people a lot of this, right?
Okay.
We give him a program where they're going to give him a grant for $19,000. $19,000. I wish my wife was here. She'll tell you some good ones. Like she'll remind me a lot of ones. Because what I try to do, Don, to stay sane, I try to erase it out of my head and I move on to the next one. Right?
All right.
Who gives up $19,000?
All right. So you
He
try to
gave
get
it up because of the rate. That's why. And he brought the rate down to get a lower rate. And he took money out of his 401k. So he took money out of something that was producing money for him.
Right.
He takes it out of an income producing
vehicle.
Vehicle, and he puts it in a dead vehicle.
When you gave a rate. Because you gave him a program where he can get $19,000.
His total cost out of pocket with the program we put him on, was less than $2,000.
Wow.
He didn't know. I gave him our last episode. He's listening to all these pod people all over and all this other stuff, and listen to all these gurus that probably don't do what they say they do. Right.
Right.
Listening to them, and he said, I was talking to some people. And this is what I said to him, young dude, respect for him and everything. I said, you know what? I said, here's the thing. I told you whatever you want, I can get you. I said, but you're not clear. I said, I'm a very clear person. I said, you said you didn't want to put no money down. And you had a grant of $19,000. You said no to it for a lower rate. And I said, you didn't use the right numbers equate. You didn't have the right numbers or the right tools before you made your decision. And I was like, but I'm happy for you. I went to his house, nice house and stuff like that. But I was like, what you didn't do was the numbers of how much you would have saved and how much more money that you put down, how much more money you could have made, because he had to bring about $15,000 to the table.
Wow.
I had already negotiated with the sellers to pay over $12,000 to go towards his closing costs, which he used all that money to buy the rate down. What people don't understand is the money from saving, what Don is talking about, or you haven't looked at it from another standpoint, was if I move in this house with very little money out of pocket and I have this money, right? Don's program is still going to have you pay that house off a lot sooner. But what you didn't realize that you could have taken a portion of that money. What type of return that he had on his money if he put it in some type of instrument or insurance instrument or some type of, or maybe put it back in his business, right?
Right.
How much more money could he have made with that money? along with using your program of paying the debt down where you have more equity. People don't look at it that way. When we look at it, we look at it from all aspects, not just one aspect.
So Jerome, here's what he didn't do. Okay. Here's what he didn't do. He didn't take advantage of the $19,000 you would have gotten for him.
Yeah, he said no to it.
Plus, he took $15,000 out of his retirement fund, used $15,000 of his own dollars.
Exactly.
So what it actually ended up costing him was $34,000. The $19,000 he didn't get, plus the $15,000 he used, that's a total of $34,000 it cost him to do it on his own because he didn't believe you.
Didn't believe me. And this is what I said to him. I said, here's what the problem you have. I said, and I don't mention this a lot. I said, you don't believe me that I have a mortgage company that has over 266 banks because I look like him.
Uh-oh. Let's not go there.
No, I'm going to go there. No, I believe you. I said, no, you don't. I said, because you look at me and just saying, I'm just running my mouth and I'm just talking, and you don't believe that I know what I'm talking about. And it's okay. It's okay.
Wow.
It's okay.
Wow. Ladies and gentlemen, we're going to take a break here. All right. We're going to listen to what Eric Thomas has to say. And I'm going to come back. I'm going to come back and show you what Jerome was just talking about, that the lowest interest rates, I'm going to prove to you that the lowest interest rates are not the best interest rates. I'm going to show you the numbers in about 1 minute. Hold on. We'll be right back.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down from my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
All right, folks, we are back. We are back. Let me see here. Let me take this banner off. Let me go here. Take this off and go here. I gotta get an engineer so my engineer can do all this for me. That way I don't have to keep doing it. So listen, folks, we're gonna jump back in. I'm gonna bring Jerome back. We're gonna jump back in and talk about how people are making decisions for an interest rate, when they should be looking at interest cost. So what you want to do now is understand what E.T. understood. It says, listen, the P.I.L.L. method knows what they're talking about. All right. So what we want to do is this, ladies and gentlemen. We want to go to ice10k.com and get a savings and earnings report. So go to ice10k.com. All right. And it'll take you here. Here's E.T. You can watch that little video that we just showed, ice10k.com, and then do this for me. ice10k.com, and then get a savings and earnings report. That way you can know the month, day, and year you can be debt free at the higher interest rate. If you can afford the payment, you're better off at the higher interest rate than at the lower interest rate. We're going to prove it to you right now. Anybody that's talking about finances, ladies and gentlemen, anybody that's talking about finances, make them show you the numbers. Make them show you the numbers. So let's bring Jerome back in here. Jerome, how are you doing, sir?
I'm doing excellent. Doing excellent.
All right, listen. How much time can you let me know? Because if you're busy, you're a busy man, and it's quite all right. We're going to be here after you decide to go. But how much longer are you going to be with us? How much?
Well, I have a team. The last time, my team better be working because I don't do this stuff by myself. With Anna and Franz and Mark,
Right.
Jeanette is up there working on some stuff right now. So
Okay.
they know they covered me.
Okay.
I'm hoping everybody's getting something out of today's show. This is important to. It's important to us, Don. Right, that people get this information and look at things a little bit differently. Right. I think the last we were talking about, Don, is understanding, right?
Right.
So I want everybody to, because I talk to a lot of people, Don. We get about over 4,000 inquiries a year. We're about to, this year, we're probably going to get somewhere, amount of 10,000 people just asking. We're going to start doing workshops virtually when people come in and get this information and understanding, right?
Right.
One of the things that I tell people is to give people encouragement is that I'm not just saying these things. I just want people to get understanding. And I want for people, households, which is a concern for me, is that understand one of the articles I'm reading right now that my wife gave me is about how much do you need to earn a year to live where you're living, right? There's one thing of people reading the article, but then believing, just like when people's believing that you don't have to put a down payment on a house. There's a lot of people I'm talking to about now and changing their mindset and saying that, okay, once you realize you don't have enough money coming in, Don, and people don't talk about this. And people do come and work with us. And if I told you the countless people where they've changed their careers, their thought processes, their increase of information, of increasing their household income, because I'm real big on that, Don.
Right.
Real big on people changing their household income so they can get the things that they pray for and they desire in life, right?
Right.
That comes from understanding and being around the right people that's going to make you that mindset to make you do what you need to get done. Like IT, the IT industry is open to just about everybody. You can learn IT and you literally could work yourself into an 80 to a 100 plus position, right? That's just one industry you can do that. You can get into medical. We talk to women all the time. It's like, well, or guys, hey, what are you doing right now? What did you get your degree in? What did you start off you were doing? So when people tell me what they're doing, I hear numbers. I don't hear their occupation. Does that make sense?
That makes sense.
So when I hear the occupation, my wife is the one that has taught me, because she's in HR management. She's like, people really don't understand their value or what they could be worth based on their skills and what is worth out there in the industry. I said, what? She was like, people don't understand where to place themselves, where they can make more money, nor they understand what that is. And I had to take time to really understand that there's people out there that have the skills. If they put it in the right place, they can make so much more money. It's just because nobody never told them, or they didn't have a understanding where that comes from. So once you increase your household income, the other things that we're talking about, then you can start talking about patterns, right? Because marketing is all based off of psychological patterns. Like with AI and stuff, we know exactly how much time you spend on the things you spend, how you think, and what you're probably going to do based off of your patterns, right? And so we can market to you because of those things, right? And so the same thing that computers are doing, your best computer is the one that's in your brain, right? And to make a decision and say, I'm going to do this, because if I do this, right, especially if you have children, if I do this and I understand this, then I could teach my child this.
Okay,
if that makes any type of sense.
Then let's talk about this. What we're going to do now is put this on the screen. All right. We're going to add this to our screen. All right. And add this to our screen. There we go. All right. So Jerome, we're going to show you, I've got a 7% interest rate here. All right. And right now that's where the interest rates are. And people are afraid if you're about to buy a house If you are about to sell a house to buy another one,
Mm-hmm.
don't think you're locked in, because the house you're selling a house that where you have an interest rate of 3.5, but to purchase the next house, you're going to be paying 7. Do not let that get in your way. That is a psychological situation. Let's show you the numbers so that you can get past the psychological part and do the part and understand the numbers part, the math, that you'll see that you're actually going to be in a better position, all right, in this new house. So some people are holding on to the old job because they have a 3.5% interest rate. They don't want to go to the new job because it's in another city, and they have to spend now they have to pay 7%. You know how many people they call that a locked in syndrome? Locked in. They feel locked in because they have the 3.5% interest rate.
Mm-hmm.
And they don't want to go to the 7% interest rate, even though they can afford the payment. They feel that they're making a wrong decision. Let me show you something right here. Here is a $400,000 mortgage at 7%. The payment is $2,661.21. And it is, for some people, it's undesirable. But let me tell you something. The thing that you want to understand right now, ladies and gentlemen, is when you control the principal payment, you control this loan. Control the principal payment and you control the loan. The interest payments you skip don't matter. Interest payments you skip don't matter. Watch this. So when I make my payment of $2,661, look here, they immediately discount my payment by $2,333.33 is discounted. So only $327.88 is applied to my loan. Okay. That's what people are afraid of. And it's only because we're not taught how to make this thing work for us, because we're not taught how to read an amortization schedule. This is our goal at the P.I.L.L. method. Our goal at the P.I.L.L. method is to show you and prove to you that you can make this work for you once you understand what's going on. Okay. So let's say I make my payment in January. All right. And then I'm looking at February's principal payment of $329.79. So here's my question. Do you have to wait till February, Jerome, to give the bank this $329.79 that we see here on line 2?
No.
No. If we have it, we could give it to them in January, can't we?
Yes.
Okay. If we do, that immediately goes to principal. We're paid down to line 2 on our amortization schedule, and our next mortgage payment is actually on line 3 of this schedule. So what just happened? For $329 that was sitting in my bank account, making 1/10 of 1%, 1/10 of 1%, $329, I applied it to this mortgage and immediately eliminated line 2 from my mortgage. It's gone. Payment number 1 is now touching payment number 3. All right. And this is my new February payment right here. What happened to this $2,331.42 in interest? I never have to pay it. It's gone. I don't have to pay that. Now, what would happen if I decided to pay payment number 1, and then I gave them payment number, I decided to, let me give you the principal payment from line 2, 3, and 4, a little over $1,000, a little over $1,000. Look how much interest I just saved. Over $7,000 in interest I never have to pay, because now I understand how this thing works. And now, instead of on payment number 2, I make my very first payment, I'm on payment number 5 of my amortization schedule, and I just saved $7,000 I never have to pay the bank, because my interest rate is at 7%. Now, what would happen if my interest rate was actually 5%. 5%. Let's take a look at that. Let's bring up that interest rate of 5%. Remember, control the principal payment and you control the loan. Here's that same $400,000 at 5%, everybody. If you want to see these numbers, if you're watching me, click the link at the top and you can see these numbers on YouTube. So 400,000 at 5%. Look, the payment is less. We were at 2661. Now we're at 2147. That's why we make a decision on this to get this lower payment. Okay. But I need you to see something. Look at my principal payment is $480 here and $482 here. Let's go back to the 7% interest rate. Look, $329 is my principal payments. This is what you attack the loan with, is with principal payments. And your money per dollar does more for you to get rid of payments and to get rid of interest. When you lower the interest rate, you increase the principal payment and your money does less for you when you work to prepay. What does that mean? Watch this. If I take a look at principal, cumulative principal and cumulative interest right here, okay? Mm-hmm. And for the year, if I do it the bank's way, I will pay them $4,000, which would go to principal. But look how much goes to interest, $27,000. 27 grand in interest just to pay the loan down by $4,000. That's what? $32,000 I got to pay out just to get $4,000 in equity. That's crazy money. That's crazy money. So, but what if I prepay this? What if I'm fortunate enough to have a little money in the bank? Mm-hmm. Do I have to pay this $4,000 in 12 monthly installments? What if, Jerome, what if I let you help me and you got me $19,000 that I didn't have to use as a down payment? Mm-hmm. Okay. So there's a possibility I could have $4,000 sitting in the bank. I could prepay this with payment number 1, be paid down to line 12 on my amortization schedule in just 1 month instead of 12, and skip all the interest payments between line 2 and line 12. I just saved over $25,000 with money Jerome helped me to get, and I just stuck in the bank because I didn't need it to move into my house. Are you listening to me, everybody? Okay. We're telling you the cheat code to use the bank's money to benefit your family and start building generational wealth. It's right here, right now. Listen to it. Now, if I could prepay at 7%, if I could prepay $4,000, I need you to see the same money, okay, the same money that Jerome was able to get from me, all right, at 5% does this for me. So I'm going to go to the 5% loan. So let's prove it. I'm at 5% here on $400,000. Let me show you what $4,000 out of my bank account that Jerome got for me, what it does for me. Look here. It only knocks off 8 or 9 payments instead of 12.
In 12 payments, it's almost $6,000.
Look at there. So to knock off 12 payments, I need almost 6,000 of the dollars Jerome got for me instead of just $4,000. So when you lower the interest rate, you make it harder to prepay and save money in interest.
So Don, I have a question.
Go right ahead with your question.
Myself, because I hear people's analogies in the head. So is it that the bank, the savings that person thought they were getting, they just added in the interest to get it from the client? Is that?
No, what happens is it's totally irrational. You see, the decision not to do this had to do with their perception of lower interest rate means better interest rate without any foundation in math.
Okay.
That's what it's all about. Nothing's hidden. It's all right there. But we're not taught how to read it. We're not taught how to do this. Let me tell you all the people who are not taught how to read an amortization schedule and how to use it for them, how to make it better for themselves. Okay, are you ready?
I'm ready.
Okay, your accountant did not learn how to read and understand amortization schedules. It's not taught to them. They're taught how to produce one. They're not taught how to make it so that it can be an advantage to them. They're not taught how to read it. Okay, your accountant, your CPA, your real estate professional. If you are a real estate agent, you don't need to understand how mortgages work to get your license. So you're a real estate agent as well, Jerome?
Exactly.
Were you taught this, how to read an amortization schedule to get your license?
No, you don't need to know.
If you're a broker, you don't know either because it's not taught.
It's not taught.
If you are a loan officer, I mean somebody who goes to school, takes a class so that they can pass the test to become a loan officer, do you realize this isn't covered?
It's not covered.
To become a loan officer, you don't need to know how loans work. This is why no one knows about this, and it's not taught at any level of financial education, not even at the Wharton School of Business. Are we being taught how to use an amortization schedule to our benefit? It's not taught. This is why I'm scrolling this at the bottom of the screen, because I'm going to be live in Orlando, okay, all day, live in Orlando, January 31st. So, and you, if to get more information, you just text the word PILL, P-I-L-L, to 256-215-9496 to get more information about our our conference. Okay, Pillars of we're going to do Pillars of Prosperity Conference in Orlando, where we're going to be going over all of these subjects in detail so you can know the truth about how to leverage the bank's money. Are you ready for it? Are you ready for it? Okay. So that's just to prove, Jerome, that's just to prove that the lower interest rates are definitely not the best interest rates. And I'm going to show one more situation here where people, because you mentioned people buying houses when it was difficult in the 70s. Okay. So the average home was around $70,000 at the time. Okay. 70 grand right there. And interest rates peaked at 18%.
Right.
Okay. And your parents and your grandparents who had this mortgage actually paid these loans off easier then than they do now. Let me show you why. It's easier to pay off now. Look at this. Okay. The payment is $1,054.96. Let me show you how this loan breaks down. Look at that. Look at the principal payment. Remember what I said? Control the principal payment and you control the loan?
Yes.
And interest payments you skip don't matter? Look at this. Look at what we just learned today. By making the very first payment, all I have to do now is come up with $5.03 and I can knock out payment number 2. It's gone.
Wow.
This is why they were able to pay off these loans. They didn't understand why it worked. They didn't need to, but it did work. Let me show you. If I could come up with an extra $64, $64, it knocks off 1 year off this loan and saves $12,000 in interest I never have to pay.
Wow.
So the higher interest rates actually worked for those people who actually went out on a limb and got a mortgage. Okay. So if you got a mortgage back then, all right, and you lived in that house in, let's say, New Jersey or New York or even Houston, how much is that house worth now? Lord have mercy. Are you hearing me, ladies and gentlemen? Don't hesitate on this thing. Don't sleep on this thing. Take this information where you think it's going to be difficult and do your homework and get these consultations. And right now, they're free. You can get a savings report right now by going to P.I.L.L. Method, ice10k.com, ice10k.com, and get a savings and earnings report for free. And by clicking on the link here that says get your savings and earnings report, and you can contact Jerome, right, Jerome?
You can contact me.
All right.
We'll do a consultation.
And do a consultation and learn how to get that house with no money down and use that money to build equity. The money that you didn't have to spend, you now use that money to build equity faster and cheaper and start building generational wealth for your family. Wow. So listen, folks, I'm just at a loss. So Jerome, we've got a lot more stuff to cover today. So right now people are getting ready to refinance their loans because interest rates are getting ready to come down. Do you have any more information before I jump into refi, what we call refi fantasy?
Right now, I'm the student, so it's about to happen. People are going to be calling us to do streamline refinances, and we know it. The season is about to happen, and people are going to be sold that they're going to be sold a lower payment. Right? That's what we're going after. Is the lower payment. Even when you were talking about the $400,000, I was taking notes, and even with the $400,000 example, right? And I know what people are going to say. They're going to say to me today, they're going to say, "But my payment is, $500 more, right?"
Right.
Mm-hmm. And they're going to just get wrapped up in the payment, and they're going to go find this money, right, for whatever they're going to do to get the money, so they think they're saving money. Yeah. Psychologically, that's what they believe.
That's what they believe. But here's what happens, folks, psychologically. When it comes to finances, okay, the scientists refer to it as behavioral economics. Behavioral economics. Human beings make irrational decisions when it comes to money. Irrational because we make decisions based on feelings and not on numbers. Okay. So when you make a decision to lower your payment without knowing what that means to you in long-term costs, that is an irrational decision. That's one thing. The other thing is this. What happens when you lower your mortgage payment? When you lower your mortgage payment by $300, $400, $500, even if it's $1,000, you feel good for a while. But psychologically, what begins to happen? Your expenses begin to grow by that same amount of money, and you never end up saving it.
Wow.
You've seen it happen. I lowered my payments by $500. Mm-hmm. Within 6 months, I find something else that takes that $500 out of my pocket monthly. I spend that money because no one is teaching us how to take that money and invest it. So let's talk about refi fantasy right about now. Okay, so we have this $400,000 mortgage. Okay, most people keep a loan between 5 and 7 years. Okay. So let's just say I've had this loan for 5 years. All right. So I go down, I had this loan for 5 years. We're going to go down to 60 months. And I'm going to show you what's going to happen here. In 60 months, look what happened. Paid this loan down by $23,000. But how much interest did I pay? Jerome, are you seeing my screen?
I'm seeing your screen, $136,199.01.
So I just paid out $136,000 in interest. And I ask my clients this when they've had this mortgage for 5 years. And I ask them, how easy was it to pay all of this money? You know what they tell me? It was very easy because they weren't looking at it. They weren't counting how much interest they were actually paying. Okay? They weren't counting the money. So they got $23,000 in equity and it cost them $136,000. And now they want to refinance. Okay? Because the interest rate dropped to 5%. Let me show you what happens when you do this. This is why we call it refi fantasy. If you want to see these numbers, you definitely want to go to YouTube right now and watch these numbers. So here's what I owe now, Jerome. I owe $376,526.41. And I go to the bank, and guess what? Most often, which I find crazy, your own bank is going to offer you a refinance.
Mm-hmm.
They have you locked in at 7. Did it ever occur to you why they would come to you and offer you 5? Did it ever occur to you why that is? Because they have you locked in at 7, making a whole lot of money. Why would they offer you 5% so that they can lose money? In fact, ask yourself this question. If I'm saving money by refinancing, who has to be losing money? Think about it. So here we are. We have 376,000. So we're going to copy that. Okay. So now we're copying that. We're going to take that mortgage and we're going to duplicate this tab here. We're going to put that money into this mortgage. This is how much we owe. And if you're using Brett Whistle like I do for these examples, all right, we have to remove that comma because the comma won't work in it. So we remove the comma. This is our new amount. Okay. We got to take out the payment because we have a different payment now. And our interest rate is 5%.
Okay.
So now let's talk about what happens 99% of the time. 99% of the time, they're going to get a brand new 30-year mortgage. So I've been in this mortgage 5 years, Jerome.
Mm-hmm.
And now I get a refinance to 5%. So I'm saving money. So let's take a look. My payment now is $2,021. Okay. Versus $2,661. And I'm feeling pretty good about that. Okay.
Right.
But I've been in the loan for 5 years and now I have a new 30-year loan. Doesn't that mean I have a 35-year mortgage?
I mean, that sounds logical.
I've been in for 5 and now I got a new 30-year loan. 30, that's 35 years all day, folks. Now, we talked about refinancing the $376,000, but I didn't give you all of the information because I didn't add in what? The closing costs.
Closing costs.
Okay. Now, I don't know around here, closing costs could be somewhere between $8,000 and $12,000. I don't know what it is in Texas. Closing costs on this would be right about what, Jerome?
Let's just use the same amount to make it easier for everyone. Let's just use the flat $12,000.
Let's just lose a flat $12,000. Okay, so that would mean I have to add 12,000 to this, so it would be $388,000. Correct? Okay, 388, 526 because I added my $12,000 to this loan. Okay. So now so my payment is not 2021 anymore. Okay. My payment now is 2085, just a few bucks more, because that's how it's sold. Just roll it into your mortgage. Okay. But it's at 5%. So I feel better. It's at 5%. So I feel way better. Okay. So now I'm looking at this thing, but here's what I need to do. My mortgage used to be, because I was in it for 5 years, okay, $376,000. So what do I have to do to get down to my $376,000 where I was before? Okay, so now they start paying on this mortgage, Jerome. Watch this. Look at their principal payment. It's actually higher. $466.83.
Wow.
Where where they were is $462. So their principal payment was smaller. Remember, the smaller the principal payment, the better off you are if you're trying to attack this loan. Okay. So now they say, oh, okay, I just increased my principal payment. Look at that. It's higher. So if I attack this loan, then my money doesn't do as much work for me. Now let's do what we have to do. Let's see what we have to do to pay this loan back down to, let me see here, down to a 5-year place where I owe $376,000. So now I owe $388,000 because of the closing costs. Okay. So Jerome, cumulative principal. I'm making my payment every month because I have a lower payment and I'm feeling good about it. But in 1 year, I paid my loan down by $5,700. I haven't even covered the $12,000 they rolled into the loan, have I?
No.
No. How much interest have I paid on this $5,700?
Almost 20,000, but 19,000. Let's say 19,200.
I'm trying to pay off the $12,000 I rolled into this loan, Jerome. Okay. In 2 years, I haven't even paid off the 12,000 yet, and I'm up to 38 grand in interest. I finally, in the 25th month, paid off the $12,000, got back down to the $376,000 I was before I started. It took me 2 years, Jerome, to get back to the $376,000 I had when I started the whole process. How much interest did I just pay?
Wow.
Almost $40,000.
Wow.
So when by the time it's all said and done, okay, this refinance to get back to where I was before I started cost me $52,000. I paid 30. Listen, Jerome, if I came to you and said, Jerome, I'm going to lend you 12,000 of my dollars. I'm going to lend it to you for 2 years, 1 month. All you have to do is pay me $39,868 interest on that money. What would you say? Does it make, do you see what I see when I look at these amortization schedules? Are you seeing this when people feel as if they're getting a deal when they're really not getting a deal? Listen, so Cataline, as it says here, that's watching us on YouTube, she says, you're starting all over with a loan when you refinance. Look at that. You're starting all over. And some people will say, well, Don, if I've already been in the loan for 5 years, why don't I just get the next loan if I refinance? Why don't I just get it for 25 years? I've already been in for 5. Why don't I just get it for 25? Folks, it's not much better, even if I get a 25-year loan. In fact, here's what I'm going to tell you about that. Never, ever, ever, never, ever get less than a 30-year loan at any time. When you lower the interest rate and if you lower the term, you're actually putting yourself in a position to stay in the loan longer because it's going to cost you more money. Yeah, Don, I need you to prove that to me. So let's go ahead and prove it. So we're going to go back. I got my 5-year look. I got my 5-year. I got my 5%. I got my 388,000, right? So let's do 300 months instead. That's got to be better. Okay. My payment is 2,085, right? So let's take a look at that. It's down to 300 months. Ooh, 2,271. My payment is actually higher. Okay, so I got a slightly higher payment. Look at my, okay, let me take these advertisings off. Look at my principal payment now. $600. If I want to take 1 month off, I got to use $600 now. Look at that. And to pay off the $12,000, well, I can still do it in 18 months, but it still costs me $28,000 to do it. But my payment is higher and my principal payments are higher. So if I want to attack this loan, in such a way that I can pay less interest, so I can pay it off in 7 years by lowering the interest rate and lowering the term, I just made it harder to save interest money and to pay the loan off in 7 years. I just made it harder. It's a lot easier if I just left things alone.
Right.
And attack this 7% loan and be done in 7 years. Why is it that people don't understand this? Is because we're not taught in school how to read an amortization schedule. We're not taught in school what refinancing actually does to a loan. We're not taught in school how we can actually do things opposite of how we've been taught to keep our interest rate right where it is, because by lowering it actually puts us in deeper. And let me tell you this, the people who work in the bank don't understand it. The people who own the bank understand it very well. They know that you're going to be in debt longer and cost you more money when you lower the interest rate and lower the term.
Wow, Don.
Jerome, have you ever seen that before?
I've seen this before because you taught me and I read the book. And right. Don, every time just sitting here has me questioning a lot of different things now. Yeah. Because when people come to me, and I'm thinking about Franz that was on the show last time, if you go back and see that episode.
You're right.
He was telling me how he acquired a house, but now it has me questioning more things. Like if you have $25,000 and you're talking about doing a specific investment in real estate,
mm-hmm.
Sometimes I'm thinking what you just showed me here, that is better. The better investment was going into your program and saying what to do with the 25 to see the true numbers.
Right.
I'm talking about the true numbers. Is that 25 better to pay less interest on your own home? You know? So these are just questions. It's just thinking about, now you're having me thinking about a lot of different things just because you showed this to me. It has me thinking about a lot of other things that we do subconsciously thinking we're doing better, but we really don't know the numbers behind the decisions we're making.
Listen, if you're watching us on if you're listening to us on Clubhouse, go to YouTube and watch these numbers. If you're watching us on YouTube, Facebook, or LinkedIn, put your questions in the comment section. If you're on Clubhouse, come to the stage and ask your questions. I'm here. Jerome is here. I'm here. Ask us any question that has to do with any of these subjects. We'll be glad to answer your question. Raise your hand. Come to the stage. Ask your questions right here, right now, and get the answers for free. Jerome, do you know there are some people who are paying off high interest debt using consolidation, taking money out of their equity, and then paying off like $50,000 in high interest loans? I mean, some of those credit cards can be 20, even 30%. Okay. So if I can take money out of my equity and pay off loans that are costing me anywhere between 7 and 30%, I mean, my goodness, I pay off 50 grand. Do you know I can probably lower my payments by $1,000 to $1,500 a month by consolidating? That's how this is sold, right?
Right.
Okay. So let's take a look at that. Let's go back. Let's go back here, and we're going to take out some additional money. We're going to take out some additional money. We were in this loan for 60 months. Okay, we have some equity in the house. Okay, so we're going to take our 376,000, right? And let's say we can take out 50 grand in equity. All right. So that's going to be plus $50,000. Okay. That equals 426,000 plus the 12,000. All right. So plus the 12,000 in closing costs. There it is. So now we're at $438,000. That's more than we started with, because we started at 400,000. Now we're at 438,000, but we're at 5%. So let's go ahead and put that in 438,000. Okay. 438,000. Oops, I'm hitting the wrong numbers. 438,000, 5%. And we're definitely going to get this at 360 months. Okay.
Right.
Okay. Because that's going to keep our payment within reason. Okay. So we were at 2,600, but now we lowered our monthly bill, all right, on these by $1,500 by paying off $50,000 worth of debt. It's gone. Okay. And we lowered our mortgage payment by about $300. So we're feeling really good now. But I just added $50,000 into a 5% mortgage. And I think that because I put it in my 5% mortgage, that's better than having the 30% credit card. That's what we're led to believe. But let me take some of these ads out of here because they're distracting. All right. I'm just going to cut to the chase. What would it, I need to, let me see. Did I do something wrong here? Yeah, I did. I added a 0 when I shouldn't. Let me take this 0 out. I got to delete a 0 here and get a new payment. There we go. There it is. Here's my payment. $2,351.28. That's my new payment. Okay. And it is about $300 cheaper. Okay. And let's take a look at, Jerome, I'm going to take a look at cumulative principal and cumulative interest.
Okay.
How long is it going to take me to pay off $50,000 that I added to this loan? We're just going to scroll down to 50,000 because I added it to the loan.
Okay.
We're right here. Okay. How much interest did I just pay on that $50,000 I added to this loan?
139,000.
139,000. Let me ask you, Jerome, if you borrow $5 from me and I say, great, here's $5, pay me back $10 tomorrow. That's $5 interest on a $5 loan. What's that interest rate?
Wow.
Isn't that 100%?
That's 100%.
100%. So if I borrow $50,000 and pay it back with $50,000 in interest, what's that interest rate?
100
That's 100%, isn't it? What if I pay back the $50,000 and I pay $100,000 in interest? Isn't that 200% interest?
Mm-hmm.
How about $139,000? That is 239% interest on $50,000 I used to pay off high interest loans that were no more than 30%. And now I traded all of that just so I can pay 239% interest on the same $50,000. And it's going to take me nearly 7 years to pay it back. So, Jerome, I'm going to ask that question to you again. Can I lend you $50,000 if you know that it's going to cost you in less than 7 years? I'm going to charge you $139,000 in interest?
No.
But people who refinance do it every single day. This is a person with perfect credit.
Right.
Even with perfect credit, they can get fooled into paying 239% interest because it's wrapped up in a loan and we don't see it.
Don, my head is spinning right now. Something you said earlier.
Yeah.
We sell off of somebody's feelings, right?
Correct.
Right. So when somebody comes to us and they want to do a cash out refinance, all they see is that, or what's being sold to them is that you don't have to make, let's just say, I'm going to save you $600 a month.
Right.
And that's what's sold, right?
That's what's sold. Yes.
What's sold for this. And that's all somebody wants to hear at that time, right? From who, and they're looking for somebody, right? To just give them the money because they don't have to pay that $600. That's all they want to hear.
Right.
And so how do you, and Don, and something else that you said was, even when and we see this because even on the mortgage side, right? We know that person's going to come back to us again because they're going to add more debt to their situation with that savings.
Wait a minute. Are you saying I'm going to pay my credit cards off to zero? Credit cards that got me in trouble before. I'm going to refi.
Right.
Pay those cards off. And because that by paying the cards off doesn't actually teach me how to manage my debt.
No.
I'm going to run the cards back up.
Yep.
Come back 4 or 5 years later and do what?
You're going to do it again.
And do it again.
So when I first started out in this business, when I used to help people buy a house, they didn't have to put a down payment down. I knew I was going to see them again 2 years or less to come back to me, right? So they could take their money out of their equity. I knew I was going to get me get paid 3 times.
Wow.
Out of that one client.
Do you see now, ladies and gentlemen, you see what's going on here where we can now come together and help people save money, do the right thing, buy their money, and look at how you can get equity a lot cheaper and a lot faster. I need you to take a look at these loans like you take a look at when you're buying meat or vegetables or fruit at the grocery store. How much is it costing me per pound? How much does it cost me to buy this thing? I need you to start asking the question, what is the overall cost of borrowing money? And can I lower the cost of borrowing the money? Because if I can lower the cost, I can get the same asset for 2/3 less. I need you to start seeing things in numbers, and not, when it comes to your finances, doing it in feelings. Because right now, if we look at this loan, the bank wants $558,000 in interest for this loan. If you work with the P.I.L.L. method, okay, instead of paying $558,000, okay, how would you like to pay $175,000 instead of $558,000? And you can live well while you're doing it. You don't have to live like a pauper. You can put more money away in your retirement fund and own the house in about 7 years. Oh, what is Joseph saying? Joseph, what are you saying here? Okay, hello. I'm looking at to me. Oh, Joe, what is this? What is this? Looking to start and grow. Oh, no. Sorry, you can't be selling in here. Not today. All right. I thought you were. Says Don, can you show us better ways to navigate having a mortgage of $90,000 at 7% and a vehicle loan at 4.4% at the same time? Yeah. Our program looks at all of the debt and helps you to make a decision on the right loan at the right time. So let me do this. Okay. We're going to bring up our opportunity cost calculator, because that's an opportunity cost question. So let me open this and bring that up to answer that question. So Joseph, we've got a mortgage and we've got a vehicle loan. Okay. Now I'm not going to use exactly those numbers, but because our program already I've got some pre-programmed stuff in it. So let me pull this up and then we'll bring it over and I'll show you how our program discriminates between loans so that you're not looking at the interest rate, but looking at the interest cost. Okay. So let me bring this over. I'm going to plug this in right here. All right. This is our opportunity cost calculator. All right. So we're going to reset the account and we're going to use this template here. All right. So I've got a mortgage in this one, I've got a mortgage, Joseph. Okay. I got a mortgage of 200,000. I've got a Visa at 21%, and I owe 2,000 on it. And I have a car loan of $25,000 at 4%. Okay. All right. So let's take a look at this. The program is saying if we have a budget to use so John makes $950 biweekly. Rebecca makes a weekly salary of $700. So when you average it out, okay, over 12 months or 52 weeks or whatever, however you average it out, it comes to $5,091 a month. That's their average. Their bills right now come to an average of $3,760 a month. That means they have about $1,300 in discretionary income. Now, this fluctuates because your expenses are, they're going to be more or less depending on how much gasoline, how much your food is that month, how much, how many movies did you buy when you were watching TV at home. All of these things will, adjust how much you're actually spending. So our program will take a look at how much you're making and how much you're spending and then give you recommendations based on how much money you actually have left over each month. Okay, so let's take a look at this action plan. So John and Rebecca Jones already know, okay, this is what they know. Just before they make their very first payment, their potential interest savings, $179,689
Wow.
that they'll never have to pay the bank. They know that going in up front. And because they will not give that money to the bank, that means more of their money that they already make. So you don't need to make more money, ladies and gentlemen. You just need more of the money that you make go to pay down the loan instead of being discounted as interest. So because of that, they can be now out of debt in 7.7 years, right? Just by following the program. By telling the program how much they're making and how much they're spending, the program with these little arrows will tell them how much to put in savings. Put money in savings because that's money they don't need for anything else. Add it, save it up, and then as they save up the money, the program is going to tell them if they started in September here, September 1, by 10/17, they're able to put $2,570 on debt because they saved it up. It's sitting in their savings account. That's money they didn't need for anything else. And so, well, Don, I see that they have bills in here, but where's the money they have to enjoy life? Oh, well, it's right here. Look here. Their unitemized budget. Okay. This money is unitemized. And in here is money they use just to have a little fun every month. How about that? It's part of their budget. Okay. But they don't spend any more than that on fun. They already figured out how much they want to spend per month on fun. Right? Once they exhaust it for the month, they're done. But here's what happens. They have to tell the program every time they get paid, they execute that. Okay. They tell the program every time they get paid, and it does the math. How much money do I have in my checking account? How much money do I have in my savings account? We're constantly keeping track of that. Okay. And when they make their mortgage payment, they tell the program, I made my mortgage payment. And it subtracts money from their virtual account, which exactly matches what they have at the bank. So we're constantly keeping track of how much money they're making and how much money they're spending. And by doing that, ladies and gentlemen, this is what budgeting really means. It doesn't mean restrict your payments. What it means is we're tracking what you're making and what you're spending. Okay. So go ahead. Go ahead, Jerome.
Sorry to interrupt you. So let's go back to in the budget where they have their fund money. I don't know what you call it, fund money. We call that blow money.
Yeah.
So each month in this example, how much do they put in that blow money?
And this, they're putting in about $500 a month just to blow.
Okay.
The rest,
if they don't
pays
use
bills.
it just sits in there, correct?
Right. If they don't use it, then the program the next month adds it to their savings account. Any money they don't spend is added to their savings account to cancel debt with.
Okay.
Okay. So to give you an example here of that question, okay, and Joseph, I'm answering your question as well. Okay, Joseph, you are so welcome here. Okay, so he says thank you. Everybody, he's typing that in. All right, so see here where the program is telling you to put $100.90 in your savings account. Take it from checking and put it in savings.
Yes.
Because that's money you don't need for anything else. What if your utility bill is not $200 this month? What if your utility bill is only $150? Okay. That is $50 remaining, correct?
Yes.
You tell the program I spent $150 on a $200 budgeted item. Then the program says, well, remember that remember the money that you were going to put in savings, we're now going to put, hold on. I've got to close this budget out. Okay. There we go. Close the budget out because we didn't spend that money. Now, look here. How much are we putting in savings now? We were supposed to put $100 in savings. How much are we putting in now?
150.
150. All right. And for sake of time, all right, if I put $200 on this mortgage, if I put $200 on the mortgage, it saves me about $1,000 in interest. Okay. $100 would save me about $500 in interest. Cut it in half again. $50 saves me about $250 in interest on this loan. You see, we don't know that. We don't know how valuable our $50 is. That's why we blow it. If I don't spend $50 on a budgeted item that was supposed to cost me $200, I just spend the $50 because I don't know how valuable it is when it comes to canceling interest. If I knew that that $50 would save me $250 in interest on my mortgage I never have to pay, I look at the $50 differently, don't I, Jerome?
Yes.
Okay. So now we're going to put $150 away. So now we're going to save up money. We're going to save. I'm not going to click on all these right now, okay, because it takes time. But I can tell you in this month, we only make minimum payments on the debt. Minimum payments on the mortgage, just the minimum. On the credit card, minimum payment. On the car loan, minimum payment. We're putting money away and we're saving it up. All right, Joseph? So the program is saying, okay, next month, we're going to put money away. We're going to put money away. And then the program gives us different information in October. By October 17, the program has done all of the math and says, we're going to take money out of what account, Jerome?
Savings.
And put it where?
On a Visa.
That's money you saved up, ladies and gentlemen. If you take it out of the savings account, does it feel like a sacrifice? If you take it out of your monthly spending of your budget, it feels like a sacrifice. But if you got to have fun and pay your bills and put money in savings, when the program says take a small amount of that money, because there's over $7,000 in savings at this point, and the program is only asking you to take out about $2,600 of it and apply it to the debt. How about that? Okay, so we're going to pay off the credit card to zero because it's sitting in the savings account. How hard is that? If I can take that money out of the savings account and pay the credit card to zero, how hard is that, Jerome?
It's not hard.
And besides that, by putting it on the credit card, do I still have it available to me to spend if I want to spend it later?
You still have it.
I still have it.
From a security standpoint, you still have it. You have access to money.
I have access to money. Okay. So that's the fungibility of money. That's a term that we go over, that we're going to be going over in Orlando in January. What does fungible mean? Money is interchangeable. We just need to understand what the cost of the money is. And the money that costs you the most is money you keep in your savings account, because you could be doing this with it, knocking down interest on the credit card and cutting off that interest train. Okay. And then this in the same day, we're going to take some additional money out of what?
Saving account.
And put it where?
To your first mortgage.
And that goes straight to principal, because the first mortgage payment is due on the first of the month. We pay that on the first of the month, and then the program says wait 17 days and put an additional $600 on your mortgage. And when you do that, how much interest did we just save because of that, Jerome?
$2,960.
Wow. If you knew by keeping your $600 in your savings account, I need you to count the pennies that they send you when they show you your statement each month. Okay. Or you could use that $600, put it on mortgage principal, and save yourself $2,960 in interest you never have to pay. what does this really mean? Look at it this way. If you pay your mortgage like the mortgage companies want you to pay your loan down by $600, you also have to give them $2,960 in interest payments. But by giving it to them when they're not expecting it, you get this equity, this $600 equity for free, and you don't have to pay them the $2,960. When you make your mortgage payment, or your credit card payment, or your car loan payment, when the banks expect it, part of your payment is discounted for interest purposes. But when you give them money when they don't expect it, it makes it impossible for them to charge you interest. What a way to look at it, Jerome.
I want to ask a question, but I want you to finish Joseph's question, because now you really just.
All right. So now, Joseph, here's what we're doing now. We paid off the credit card, and we paid off and put money on the mortgage. Now, what's left? We have a car loan. Let's take a look at it. Let's pretend that we paid off the credit card. We have the car loan now at 4%. We have the mortgage at 6%. Dave Ramsey, with his snowball method, says we should concentrate now on the car loan and put all of our effort towards the car loan and pay it off early because it's less than the mortgage. Isn't that what we're taught, Jerome?
That's what we were taught. That's what,
what we're taught.
We were told to do that, and it makes some type of sense, right?
Well, do you feel good because you paid off the credit card?
Yes.
And will you feel good when you finally pay off the car and you have the title in your hand?
Absolutely.
So that is what Dave Ramsey is selling. He's selling feelings. He's not selling math.
Right.
He's not selling the numbers. He's selling feeling, ladies and gentlemen. Okay. So let's go to our program. Let's go to our program and tell the program. And let's take a look at preferences. Let's see what because we've got everything in this thing. This part you didn't know, Jerome, because I haven't showed this to you. Okay. We can go over here to when we click on that over here to where it says program focus settings. We click on focus settings here and see that the program is on automatic. It wants to choose the amount of money we put on debt to the penny. It wants to choose what month we apply that money, what day of the month, and which loan. It's set to automatic. But you can change this so it's not automatic. You can change it. Okay. When the focus is set to automatic, the program will automatically optimize the order you pay off debts to become debt-free. You may change the focus setting. However, this could have a negative impact on your overall results. So if we follow the program, we're going to be out of debt in 7.7 years, and we're going to save $179,000 in interest we don't have to pay. But we don't want the program to choose. We want to choose. So we're going to override it. We're going to click the drop down, and we're going to click on paying the car off about 2 years early. Oh, so we can get that good feeling of paying it off. Okay. When I tell the program to concentrate on the car only until we pay it off early, watch what happens to your 7.7 years and your $179,000 in interest savings. Let's focus on the car. Program is now recalculating. It went from 7.7 years to what?
7.8.
We were saving $179,000 in interest. How much interest are we saving now?
177.
So it actually cost us $2,000 interest to pay the car off early by just focusing on the car, like Dave Ramsey says. I got the good feeling. So I asked this question in my book. Okay. How much do you want to pay for your good feelings? In this case, it's going to cost them $2,000. Even in my program, it costs $2,000 extra, where this program is designed to save you a ton of interest. It's still going to cost $2,000 more.
That's an eye opener.
Okay, now let's see why. I need to finish this up. We're going to see why. Okay, watch this. So let's go to the auto loan, and I'm going to show you why that is. Okay, I'm going to train before I forget. Let's go back to settings. Okay, let's go back to preferences. We're going to change it back. Okay, to automatic. When I change it back to automatic, it goes right back to where it was, 7.7 and 179,000. You love that? We can play around with this and do a bunch of what ifs. So let's go to the accounts. And when I show you this, it will be very apparent. Okay? Because when we pay extra on the loan out of the savings, we kill interest, don't we? Okay? So let's take a look at this auto loan. And we're looking over here to the left. I'm going to make this just a little bit bigger. Okay. How much is the interest payments on this car?
$83.33.
So when you start paying extra on the car, you start killing these $80 payments. These $80 interest payments, you start canceling them, which is okay. Okay. All right. And but I need you to see this. How much do we need to prepay to kill $83 worth of interest?
That's $377.08.
So I can take my $377.08, apply it to principal over and above my regular payment, and it will save me $83 in interest I never have to pay. While I am focusing totally on the car to pay it off 2 years early so that I can feel good about it, for the next 2 years, I'm going to make minimum payments on the mortgage because that's what Dave says to do. Okay. So we're going to go back to the accounts. I'm going to click on the mortgage and we're going to look at the same thing. How much is the interest payments on the mortgage?
$999.
While I am focusing on the car loan that Dave Ramsey told me to focus on, the car loan cost me $83 a month. While I'm totally ignoring the mortgage, which cost me one more time, how much per month?
Almost $1,000.
Folks, does that make any type of financial sense to focus totally on a loan that only cost me $83 a month and let the one that's costing me nearly $1,000 a month keep on charging me? So tell me, how much do I have to prepay over here to kill nearly $1,000 worth of debt?
$200.
$200. $200 saves me nearly $1,000 in this. This is why, ladies and gentlemen, if I just focus on the car, it's actually going to take me longer to pay off the debt, Joseph, and it's going to cost me more money. So our program is smart enough using AI to tell you, now the car is still going to pay off before the mortgage. But the program tells you when to put money on the car and when to put that extra money on the mortgage so that you can ultimately save the maximum amount of interest per dollar applied. This is an optimization program, and it is designed so that you can save the absolute most in interest that you possibly can. And it's more than just throwing money at the debt. To optimize means this: what is the least amount of money I can put on the debt in any given month that's going to give me the most in interest savings per dollar I just put towards the principal? So if I put $500 towards principal, I want each one of my dollars saving me the most in interest it possibly can. Let me tell it to you this way. If we find out that we can save $5.50 per dollar, for every dollar I place on principal, it saves me $5.50. Do I ever want to accept $3.50 per dollar, Jerome. Okay. So it matters. But if you don't have a way of measuring, am I getting $5.50 per dollar? Am I saving, or am I saving $3.50? If you are in a guessing game by just throwing money willy-nilly at the debt without doing all the math it takes, and it takes thousands of calculations to do optimization programs. This is why we do it all in the background, and you just follow this program like financial GPS. And when these arrows come up, you just do what it says. Put some money in savings, put some money in savings, take the money and put it on the debt. How easy is that? So I hope I answered your question, my brother. Joseph, did I answer it? Follow the program, and the program will tell you when and how much and which loan to attack, to the day and to the penny, so that you can save the most in interest. And it's the interest savings that drives paying off the debt. It says, thank you so much, ICE. ICE stands for Interest Cancellation Expert, folks. Listen, folks, we've been talking for over 2 hours and 30 minutes. We're going to take a break. Jerome, I'm going to take a break. We have a testimonial that we're going to play right about now. And so that's going to give us a much needed break for the next few minutes. So this is a client that we brought on early, right after they were after they graduated from college. They had a mortgage and they had student loans. Okay. So this is Mike and Beth Rosenblum, and they're going to tell you their story. But I want to share this with you. Just out of college, they decided to take a chance on this program and paid off that first mortgage in 6.5 years.
Wow.
Their student loans were gone the next year, and they went to private school. Okay. Their student loans were horrendous. Okay. They paid those off and that first mortgage off in 6.5, and then moved into another house and put a renter in that house. They're getting ready to pay off their third house on this program, and they started in 2008. So let's go ahead and for the next few minutes, listen and watch. If you want to see this, go to YouTube right now. Listen and watch where the testimonial from the Rosenblum family for the next 6 minutes or so. Here it is.
It seems foreign at first. Like, you know the interest is there and you know it exists, but you just don't completely grasp how many tens of thousands of dollars that you're paying in interest when you don't have to.
No way. That was my reaction. Like 30-year mortgage and 5 years, 6 years, no way.
So here we are, 6.5 years later, just finished a 30-year mortgage payoff, and some of those same friends are coming back to us that were skeptical at first, saying, now, what was this about again?
They're like, really? You're only 30 years old. You're supposed to be paying on that for a long, long time.
And going through business classes through college and understanding economics and managerial finance and how to operate small businesses, we understand we have debt, we have interest that goes along with that debt. But we just didn't understand how our amortization schedule was set up and how much interest we're actually spending. We didn't initially have the understanding because we haven't been taught this way before. Take a $5 cup of coffee. When you take that $5 and actually look at your debt and your amortization and how much you're spending in interest, really, $5 could eliminate about $35 worth of interest. So the $5 cup of coffee is not a $5 cup of coffee. It's a $35 cup of coffee.
It took me a few tries to actually get it. He explained it to me maybe 2 or 3 times, and I thought, okay, I don't know. I'll have to see this for myself.
Changing the word penalty to a cost benefit. The word penalty, it makes you feel like you've done something wrong. No one wants to pay a penalty or pay a fine for something. That's the question you have to ask yourself. How much is it actually costing me to pay down my debt? You're sitting there trying to look at it way too deeply, and you're looking for that catch. You say, okay, it sounds too good to be true. What am I missing? Finally clicked and the light bulb went off. We said, oh yeah, the catch is there is no catch. It really is that simple.
Every time you log in, you see that date of your complete debt payoff. That's my favorite part to see.
When you log into it and you're looking at that dashboard, you have different ways that will open up your eyes to motivating you even harder to pay off that debt. I know it's put us in a better position where we can provide a better future for our child and being able to enjoy some things in life and travel more.
I'm just super excited to be so young and to say we've paid off our mortgage and we can free up all this money to use for giving to others. There's all kinds of things that we can do. That's sort of been our financial goal at the beginning. We started in Honduras. The people there just took our hearts. We've been keeping in contact with them ever since then, which was maybe, 7 or 8 years ago.
They contacted us through Facebook and they said, we don't know what we're going to do, because the cancer treatments are just beyond reach for us. Because of the pill method, when somebody who's devastated over a $600 cancer treatment that they can't afford, which we can't imagine it's even that low, we sit here and we say, well, yeah, here's money to get the cancer treatments done. We're not only putting our child in a better financial future, but we're also teaching her how to manage the money. And it's not that we have a magical program. You still have to have discipline, and it's life concepts that we all need to pay attention to. Say hi.
You are so sweet.
In my career as a real estate agent, this technology has been phenomenal for the clients that I work with on a day-to-day basis. I've been around real estate literally my entire life with our family-owned real estate company, and some of our clients that we sat down with and were forced to sell because they got laid off from their jobs, they had hours cut back, they had to look for work in other parts of the country. And we looked at selling their property, and they said, we literally have nothing to show for our time here. We've been paying our monthly payments month after month like clockwork, and we're literally gonna have to pay someone to buy our home from us. And it was so frustrating to have this conversation and their reaction to where they were, that if they had been on a program like the P.I.L.L. method, in just as little as a couple of years, you can put yourself into having rapid equity growth, even in a declining market. A lot of friends and clients that I've talked to say, well, we can put extra money on the principal of our mortgage, paying off our smallest debts and working our way up to our largest debt and pay it off, just as quick ourselves. I use the analogy of, following a GPS, and it may pull up 3 or 4 different routes. They all get you to your destination, but the P.I.L.L. method is just way more effective. It eliminates literally tens of thousands of dollars in interest that we were going to have to pay doing it the other way. But the technology that backs up this program is just phenomenal. It's finally sinking in, I think, to some of our friends and families and clients that we work with because we're sort of walking testimonies that it works.
I think that it should be taught in schools, really, but the banks might not be too happy about that because they like those interest payments coming in.
What's interesting is that one of our most reputable lenders that we work with here in this area, her and her husband actually joined the P.I.L.L. method program just a few years ago. If more people caught on to this program and this technology, it would drastically boost the real estate growth here in our area. Her and her husband, they looked at the numbers and said, a refinance is not going to benefit us from where we are. The P.I.L.L. method is the plan that we need to put into our lives.
You heard it. You heard it. You heard it. So let me take this off the screen here, and okay, there it is. So anyway, so get your savings and earnings report just like they did. Okay, go to scrolling across the bottom of the screen, go to ice10k.com and get your savings and earnings report. Just click the link, fill out the information, and it's free. You can know the month, day, and year you could be debt free and live like the Rosenblums. I mean, they started this whole process way back in 2008, and now they own real estate. They're renting it out. They're building a future for their family. Okay, building generational wealth because they're getting that equity faster and cheaper. Do you know they can cash out refi 10 to 15 years sooner than most real estate professionals because they're saving money on interest. All right. So what did you think about that, Jerome?
I wish I would have known about something like this in my 20s, put it that way. I think, if we had access to this technology and this information, which I didn't get this information maybe really when I started and my wife and I was looking at your videos.
Yeah.
It was probably 3 years ago, but she really had me listen to your videos again. Because you have a library of this information out there for free, right?
Right. Well, let's go ahead and put that on the screen. I'm going to change this over right now and go here. Put that on the screen. There we go. And let's go to YouTube. Open that up. There it is. Here's our YouTube channel, ladies and gentlemen. And he's right. It's free. You can go to our live. That's where we are right now. We're live right now, and you can click on the past lives here. And look here. We have show after show after show on this information, and it's free. And we're helping people to understand that it is possible, and then get a program, get coaching, and get technology that's going to help you to build your financial future. And here is our promise to you. No one can save you more money than the P.I.L.L. method, okay? No one can help you to build your wealth faster than the P.I.L.L. method. And we guarantee it in writing or money back. And it's a lifetime guarantee. No one beats us ever because they don't have the technology that saves interest. Only we do.
Wow.
We're the only game in town. And it's been like that for years. Okay.
The first time I heard that, I cringed because I was like, that's a very bold statement.
Well, you know what? The thing is that even if somebody tries to do what we're doing, we've been doing this for 19 years. You know how far behind the curve we are? We're constantly improving our program. It's going to take them years to catch up to do what we're doing. Okay. They're going to be saving the kind of interest we saved people 19 years ago.
Right.
So I don't worry about it at all. I don't worry about it because we're constantly working on it and making the program better. So we have a research and development team. We have people in AI. We have people in that code. We got a whole team. We got customer service. It's all there. Coaching is there. Customer service is there. We have the resources to support you through all of this. Okay.
That's awesome.
Any questions, anybody? Listen, I need some people to come up to the stage and ask some questions. So, Jerome, you getting ready to say something?
I have a question since
Yeah.
I'm in the student seat right now, right?
Yes, sir.
So,
yes, sir.
when you were showing, is Joseph, right? Joseph, this illustration with the car,
Right.
and I was thinking that how much money you're saving people, your method of saving people. It's like I'm losing money if I might be understanding this incorrectly, but if I have this debt and I'm paying all this interest to the debt, then I'm really not making the money I think I'm making in certain investments. I shouldn't be investing. I'm talking about in whatever it is because I'm losing money in interest and not really gaining on my investments.
Yeah, that's exactly it. So put another way is because you are putting that money, you're giving the money an interest that you don't have to give them. They're taking that money and investing it. You're not. So if money that you could have made that you didn't make should be considered a loss.
Say
Okay?
that again.
Money that you could have made
Okay.
that you didn't make
Okay.
should be considered a loss. So if you're paying interest that you didn't have to pay, that means that's money you could have invested. Let me give you an example. Let me give you an example of that. I'm going to move a screen over.
Please do.
Okay. Since you asked the question.
No, I want to see it. I think everybody needs to see it. So I just told one of my clients that's on housing, right?
Yeah.
I said, I'm in the middle of a podcast. I said, you need to watch this podcast because you're trying to meet these specific guidelines that's restricting you, right?
Right.
And I said, but when you learn this, then you'll probably get what I've been saying to you.
Mm-hmm.
You're putting these certain restrictions in place because of these specific programs that you're trying to qualify for. When you
Right.
take restrictions off and you'll be in your house, in the house that you want to be in. And now you can start escalating and making more wealth for your family because this is just the first step of the process, not the final step.
Okay. So here's what we're looking at right here. This is a family. They have a mortgage that's at $188,000 for 5.99, and look at the money they have on credit cards, $73,000.
Okay.
Okay. The reason why we have this is because they were trying velocity banking and it went wrong.
Oh, wow.
They were trying to leverage the credit cards and, pay down the mortgage like they saw on YouTube University.
Mm-hmm.
But what they don't tell you when you're trying to learn velocity banking on YouTube is how much to borrow from the cards and how much to put on the mortgage and the length of time it's going to take you to pay back the cards.
Okay.
They're not giving you that exact formula. They're telling you if I take this loan and put it over here, it saves you money, but it doesn't tell you how much money. Okay. It doesn't tell you how much of that money you should borrow to put on the other debt. They're not telling you that either. They're just saying, if you take some money, put it over here, this is what it's going to do. And it's going to save you money and you'll be able to pay off your mortgage in like 10, 15 years. All right. But they're not giving you specific information. All right. So that's how they got into $73,000 worth of credit card debt at an average of 23%. Okay. So here's what we're looking at for interest cost. Here's how much interest the bank wants them to pay on that money. $349,900. That's how much interest they want them to pay.
Okay.
Here's how much interest they will pay with us. $97,676. That's a $252,000 interest savings. That's cutting their interest cost by 72%. Look at that. 72%. Do you know what your interest rate would have had to be on all of the debt to only pay $97,000? Across the board, it'd have to be 2.23%. Who can borrow money that cheaply? You can, if you have the technology that will tell you exactly what to do. Now, the money that they're saving and no longer giving the bank, okay? Because this is a young couple. In the next 21 years, 22 years, that's how much time we're saving them, 22 years. While everybody's just trying to pay off their debt in the next 22 years, you could be taking that money you're no longer giving it to the bank and turn it into $1,183,000. Or you can keep on giving the money to the bank and not make the $1,183,000. Is that what you're talking about, Jerome?
Exactly.
Yeah.
That's clear math. That's clear understanding. And I do get questions about that all the time. Another question that I receive is about methods that people are looking at on YouTube, utilizing their home equity line of credit. Can you talk about that?
Sure. That system actually started in Australia, and it was picked up by Richard Branson, and he took it to England, and then it migrated to the US. All right. So it's not new, ladies and gentlemen. And people are on the line right now. They're calling it, they're calling it a secret, or they're calling it, a legal loophole. All right. Where you put your line of credit, a home equity line of credit, in first position. So you refinance out of your loan into a line of credit. And then what you do is this. When you get paid, you take your income and put it into the line of credit as a deposit. It's like you're depositing it into your checking account. You look at it as a deposit, but the bank looks at it as a payment. So your money is actually sitting in the bank account, in that line of credit, which lowers your interest for the month, and you pay less interest because your income is sitting there, and you slowly but surely pay your bills out of the line of credit. So for instance, let's say you're putting in $6,000 a month income into this thing, and you're spending $5,000 a month on your bills, right? That $1,000 a month, all right, that $1,000 a month saves you, that $1,000 a month actually pays down the loan, the line of credit. So you put in 6 and you spend 5. You put in 6 and you spend 5. But do you know what generally happens? How people end up coming to me is because they put in 6, but they spend 7. They put in 6, but they spend 8 because it's sitting there. They have a line of credit that for their mortgage for $200,000, but the limit is $250,000. When you use that system, you have to spend less than you put in, and a lot of people do not because there's no guardrails. Okay.
So that raises up another question.
Yes.
We're being marketed to all the time. And so most people are spending more money and adding more debt, and their cost per month is increasing because they're borrowing more and adding more to their bottom line.
Right.
In their budget. So do you see people in the system consistently adding more debt and then you have to pay it off? Or does this system, you said always? Always.
I see it all the time. It happens all of the time. I have Nikkei on the stage. Nikkei, did you have a question? NK rather. NK. Nope, didn't have a question. It's gone. All right. So listen, folks, this has been very interesting. We've been here for 2 hours and 59 minutes doing this. So I want you to know that it's been a pleasure. It's been a pleasure doing this. All right. Usually we last till about 12 Eastern or 11 Central. But I got to get out of here today. I got to get out of here just a little bit early. I hope you don't mind. But listen, get a hold of Jerome. All right, Jerome, give us your phone number and your website again.
Website is Zero Down, ZERO DOWN.house, HOUSE. My cell number is 281-220-9960. Don, thank you so much for your time and your wealth of information for, I call this the master class. Thank you so much, Don.
All right, listen, thank you so much. So folks, go to ice10k.com, ice10k.com, get your savings and earnings report for free, and get ready for we're coming live to Orlando. Text the word PILL, P-I-L-L, to 256-215-9496 for more information on our conference. And don't forget to subscribe to our YouTube channel and our Instagram page. Okay, just look up Pill Method and you'll find it all. I want to thank everybody for being here today. So we're going to get out of here, but next Wednesday we will be back with more information. Okay, so listen, we'll see you next time, everybody. So take it easy and listen, enjoy your life. But folks, here, I need to say just one last thing before we get out of here. Don't let what you used to do keep you in debt forever. When you learn something new, it's better. Give it a try. You'll find out that you're going to be a lot better off. We're proving it every single day. See you next week.